phone, hit record,
for Asia travel,
and let your idea
data
fly.
provider OAG said the busiest
The future of your startup could be just one video away.
Second
Remember,
place, Cairo to Jeddah,
be
and
clear,
in third place, Seoul
be
to
passionate,
Tokyo Narita.
and most importantly,
rounding out the list,
be
number
you.
10, New York
We
JFK,
can't wait to see what you've got. Let's get funded now.
Trip to rank in the top. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, spiraling tensions between Moscow and Kyiv.
Got to be a deal. No, got to be a deal. Too many people being killed. That is a war that's on. Too many people. Got to make a deal. And Putin has to make a deal.
What does that deal look like? That conversation up next, live from New York City this morning. Good morning.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Equity futures on the S&P down by about 1/3%. Another close at a record on the Nasdaq 100. Nasdaq 100 futures this morning pulling back just a little bit. We're down by 0.2%. Bond yields are higher by 3 basis points. The 10-year at 4.43. Under surveillance this morning, spiraling tensions between Moscow and Kyiv.
Got to be a deal. No, got to be a deal. Too many people being killed. That is a war that's on. Too many people. Got to make a deal. And Putin has to make a deal. Putin has to make a deal. And Putin would have never gotten it if I was president. If I was president, we wouldn't have had inflation. Our oil prices would have been lower. I had a good relationship with Putin, he would, despite the Russia hoax.
So here's the latest this morning. Ukraine is claiming responsibility for assassinating a Russian general in a Moscow explosion earlier on today. Joining us now is John Lieber of Eurasia Group. John, how do they close any kind of deal with things like this happening?
Yeah, it's a great question. I mean, I think that we know Trump wants a deal. You heard him say it several times in that clip. We think Zelensky wants a deal because he wants the war to stop and Ukraine is losing that conflict right now. But what we don't know is if Vladimir Putin wants a deal. And we don't know what his incentives to get one are. It seems like he can keep the land. That's not really in dispute at least by the Americans. They'd be happy to carve out that part of Ukraine and give it to the Russians. Can he get sanctions relief? Now, obviously, these sanctions have been sort of harmful for the Russian economy, but they haven't really hurt the Putin regime in any meaningful way. And Putin seems to benefit from this permanent war that he's waging against the West. So it's really unclear to me, and I think Donald Trump is now hinting at that post-election, what incentives that Putin has to sit down and get to the table and get to a deal. The Ukrainians are acting like they recognize that they need to put increased pressure on the Russians, and they're acting like they recognize that a ceasefire would be in their benefit, which explains some of the recent actions over the last couple of months, including their own invasion of Ukraine, the meeting with Donald Trump last week, trying to convince him to put together a package that's more favorable to them, and then today's assassination, which they took credit for. So these things are probably about ratcheting up pressure on Putin. At this point, I would expect the United States to do more of that in the Trump administration. Trump's National Security Advisor, Mike Waltz, has talked about the need to tighten on sanctions on Russia so that they are getting less, able to sell less of their energy abroad. And he's talked about, supportively, about Biden's decision to fire more long-range missiles into Russia, which Trump, of course, says he doesn't want to do. So, we are quite a ways away from a deal, it looks like right now, and it's possible this war continues to escalate into the first half of next year.
I want to pick up on that moment when Trump said yesterday he doesn't think the Biden administration should have allowed missiles to be shot 200 miles into Russia. At the same time, in his sit-down with Time magazine when he was named Person of the Year last week, he said the only way you're going to reach an agreement is to not abandon. So can we see an incoming Trump administration really tighten the screws on Putin, and then that's the reason to force him to the negotiating table?
Yeah, and this is an idea that's been kicked around Republican circles, Trump's former national security advisors, and other folks on Capitol Hill for a while now, that the trick to getting a ceasefire is to increase pressure. This view that the sanctions enforcement has been relatively weak, that all the oligarchs surrounding Putin are still wealthy and powerful, the ones who are still alive. And, there was a hope that they could pressure Trump into adopting this increased pressure tactic. And I think you're hearing Trump talk about that. Now, of course, Trump's all over the map on this issue. He thinks that, the way to get a deal is by striking up his friendship with Putin, and calling him on the phone and having some discussions about why this is good for him and it'll all be great. Obviously, it's not as simplistic as that. And it would be a little bit ironic if, now Trump pivots post-campaign to basically the Biden position, which is that you've got to continue to arm the Ukrainians to keep fighting here and fighting a war until they win it.
John, based on my conversation with sources, the Biden administration is going to be considering outright sanctioning Russian crude, something they have not done. They've just been using this price cap in terms to try to starve Putin of the money he needs to continue fighting this war. Do you think that that is just too little too late? Would the Trump administration welcome that? Or would they think potentially this could be inflationary and they're leaving the incoming administration with this inflationary bubble to deal with if that spikes oil prices?
I think the Trump's energy policy is just drill, baby, drill, right? Get more out of the U.S., and that'll offset any price pressures elsewhere. He's got a good relationship with the Saudis, and perhaps he can get them to pump a little bit more to offset this, which is, again, what Biden did. So on the inflationary side, there's obviously global forces that would counteract that. The real question is how much pressure does that put on Putin? And I think Trump at this point would probably welcome that kind of pressure. Although the assassination today, I can't imagine that's a welcome development, given the possibility that this war continues to escalate. And Russia's got a lot of weapons they've left on the table so far that they could potentially use next, which is not something we've really seen recently, but I think is a concern for the incoming Trump team.
John, investors see the prospect of a Russia-Ukraine peace deal as one of the potential positive catalysts unforeseen right now for 2025. This, according to the Bank of America Fund Manager Survey. The other potential catalysts, positive ones, are U.S. tax cuts as well as potential AI productivity gains. One of the big negatives is a global trade war. Which of the options seems more realistic heading into 2025 to you?
I mean, we're going to get it all, right? So we're going to get. I think that you see these Ukrainian warrants rallying on the back of a peace deal. That seems reasonable, although it could take longer than perhaps Trump's been suggesting. The tariffs are going to go up. We know they're going up. They're going to go up probably at least on China, potentially on other trading partners, and if not on entire countries, then possibly on sectors like steel and aluminum. In the first Trump administration, perhaps the automobile industry is a place to watch for higher tariffs. One thing you didn't mention is immigration. Now, that's more of a domestic policy story, but it would fuel inflation if the workforce were to dramatically reduce starting next year with more deportations. And then fiscal, as you talked about with your last guest, fiscal policy, of course, remains loose. And I don't think anything DOGE does or is going to fix that. And there's not going to be any tax increases to offset that. So it's a really mixed policy picture next year coming out of the Trump administration. I wouldn't say it's at all clear that this is a pro-growth agenda, given the headwinds that are going to be introduced by some of this policy disruption. But you mentioned AI and cryptocurrency, and there's a whole bunch of other sectors that are going to do quite well in a deregulatory environment, which means you'll get some rallies in some places and then some headwinds in others.
John, it's good to hear from you. John Lieber there, if you raise your group. Speaking of the auto market, is it a winner takes all? Tesla up again this morning by 2.9%. Vijay Rakesh of Mizuho, good friend of this program. The new Trump administration policies, including the EV tax credit repeal, positions Tesla better with lower EV cost structure relative to peers. I think this is a really important point that doesn't get talked about enough. He wants those credits gone, and this is why.
Because essentially it costs less to make Teslas, and they've actually made it more efficient to manufacture, which is the reason why he doesn't care, and there's the hope of FSD.
Record high after record high for that stock. Dan Ives of Wedbush coming up on the program a little bit later. Up next, we'll catch up with Sharon Miller of Bank of America on the state of small business in America.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The opening bell about 2 hours away. Retail sales in America 60 minutes from now. Equity futures on the S&P 500 into all of that, negative by about 0.33%. Let's get you some morning movers. Let's cross over to Manus Cranny for more. Good morning, Manus.
John, good morning. Take a look at NVIDIA. When you hear from Satya Nadella, could be one of the biggest customers of NVIDIA, saying to the market, power, yes, I'm short of power, but I am not chip supply constrained. And therein lies the conundrum. This stock is now in a correction, down for 7 out of the past 8 sessions, down 4.5% in December. Breathless on the downside. Look, the question you need to ask yourself is, every sort of major correction in this stock, is it an opportunity? Because the dip on NVIDIA is mirror imaged on the other side with Broadcom. You know, Broadcom's having its NVIDIA moment, so to speak. Up 38% in 2 days, market cap now over $1 trillion. And this is about the propulsion on AI growth. This takes me back to May 2023, when NVIDIA just blasted the market, and we just didn't expect the kind of guidance and numbers that we got from them. Bank of America say the AI story for Broadcom is growing at 3x over the next 3 years. There's plenty of room for other winners. It's trading on 38 times a multiple, so there is limited room for error. As we know, these are high wire acts. Let's round it off with Pfizer, reaffirming to the market 2024 outlook in terms of revenue, $61 to $64 billion. Our COVID products going to be pretty much the same next year as they are this year. However, the IRA, there's going to be changes in the Inflation Reduction Act. That is a redesign of Medicare. That is assumed in their numbers of around $1 billion. But that reaffirmation of the revenue is the key point of the 3% bid this morning. John.
Manus Cranny, thank you, sir. A rally for that stock. Under surveillance this morning, Ukraine claiming responsibility for the assassination of a Russian lieutenant general. Sources telling us here at Bloomberg, Ukraine's security service carried out the attack, an explosive device detonating near the entrance to a Moscow apartment building.
So this is a rare example of an assassination of a top Russian general inside Russia, and Ukraine claiming responsibility. It came a day after the Ukrainian Secret Services accused Igor Kirillov of ordering the massive use of banned chemical weapons against Ukrainian troops in the country. But it also, I think, spells the fact that they know that they're going to be forced into this potential negotiation we were just talking with John Lieber about. So they're taking any moment at the tail end of this year, early next year, I think, to really try to push the Russians back and get as much as they can before they're forced to a table.
It seems like people are treating this as though escalate to de-escalate. And that seems to be sort of the understanding in markets, and that's how it's being treated. I just wonder at a certain point how much that maybe is a bit of a rosy interpretation, given the fact that Vladimir Putin doesn't take well to, black eyes.
Well, when it comes to escalate to de-escalate, it's not just potentially the United States, which Trump was saying in Time magazine, I would not abandon them, but also this morning, the European Commission saying it is prepared to end the transit deal of gas between Ukraine and Russia. Once again, trying to starve Putin of those funds he needs to continue conducting this war.
It's quite an escalation, that's for sure. Let's turn to this story. TikTok and its parent company ByteDance asking the Supreme Court to block a US government ban set to begin on January 19th. The platform asking the court to put the measure on hold by January 6th as justices consider whether to hear an appeal. Lisa, I think you and I are both on the same page. If there is a national security risk here, it doesn't matter about anything else. Nothing else matters. This is the only thing that matters. If you believe there is a national security risk, I don't care about the kids on TikTok. I don't care about whether you've got a donor who helped win you an election. I don't care whether Gen Z helped you win an election. If there is a national security risk, there is nothing above that at all.
It comes down to what is a national security risk and where is our standard for that. I will just put this out there. A Pew Research survey released in September showed that 17% of U.S. adults regularly receive news from TikTok. That is a 5-fold jump from 2020. If people are concerned about misinformation, about a manipulation of data, about any of these issues, well, this is quite clear. If they're not, well, make that point. I think that is really where our focus needs to be.
Well, Trump's former national security advisor had told me once that this is the Chinese Communist Party's greatest form of espionage into the United States. And if people are so concerned, and these TikTokers are concerned, and the company's so concerned so much that they went down to Mar-a-Lago to have a meeting with Donald Trump, well, then sell it. Divest. If you don't want to ban, divest.
National security risk on the phone, in the skies. The White House saying there's no reason for alarm as law enforcement investigates thousands of drone sightings in New Jersey and nearby states. This is President-elect Donald Trump suggests officials are keeping Americans in suspense over the sightings. He's implying that they know and that they're not sharing that information with the general public?
I'm a little bit frustrated here because we've talked about the range of potential options, and people are sick of this. The fact that Mickey Sherrill, a representative who used to be part of the Navy, she was a Navy helicopter and aircraft commander who is a New Jersey representative, basically saying there is a lack of coordination and communication among some of the authorities. Is there the authority to even talk to each other about what the drones are, the SUVs in the sky that people are finding above their houses?
What was interesting is after Trump said they know and they're not telling people, he was asked, well, are you privy to these briefings? And he said, I'm not going to talk about it. Well, he's an incoming president. We do know that, say, Jake Sullivan is speaking to Congressman Waltz. We do know that there is coordination. So I assumed that, yes, he's privy, and what he's saying is that maybe it's not too dangerous, but why are they not telling you, even though they keep saying they're quote-unquote on it? Maybe they should give more details. Trump clearly knows.
Interesting. Watch this space. Let's turn to business sentiment. According to the National Federation of Independent Business, small business confidence has jumped above the 50-year average for the first time in more than 3 years. Bank of America releasing their year-end small business checkpoint, writing, that's not to say there haven't been challenges. Small business debt levels are rising alongside a cooling labor market, but credit availability is increasing, as are capital expenditures, suggesting some of the rise can be attributed to future expansion and to growth. Sharon Miller of Bank of America joins us now for more. Sharon, good morning.
Good morning.
It's good to see you. Let's talk about the change in sentiment since the election. Are you seeing the same thing? Are you seeing a big bounce?
We are seeing optimism out there, and I think we've seen this over the past few years. So, but I do see as we come to the end of this year, business owner optimism has increased, and we are seeing capital expenditures, people thinking about the future and what that can hold for their business in 2025 and beyond.
So you're not just seeing a change in feelings, you're seeing a change in behavior. They're actually starting to make those decisions. You're seeing that activity already.
We are seeing activity, and we're seeing loan growth picking up. We're seeing lines of credit utilization uptick. And so that is a good sign for what's happening in the business sector. So we handle clients from startup all the way to 50 million in revenues. And so from small to mid-size, we are seeing an uptick in activity.
One of the fascinating aspects of the recent report that you put out is that the biggest risk isn't necessarily weakness from consumers, isn't necessarily weakness in ability to sell. It is the potential for inflation to be stickier and eat into margins. How much was that a surprise to you at a time where we keep talking about the disinflationary trend that everyone's expecting into next year?
Well, it's not a surprise because inflation has been sticky. And as you think about business owners, particularly in their rental space, so where they're doing business, that has increased significantly. And so as you think about even retailers, they're paying 30% more on average, just because they want to get a good spot so that people see them, they're visible. And those rents have come up a lot. And so that has been on the minds of business owners, not just this year, but we have seen it more pronounced.
It raises this question of the vulnerability if there is some sort of increase in tariffs, particularly for smaller businesses that might have more difficulty than larger ones negotiating more better terms, et cetera. How much was that something that you talked about with them, that you're hearing more from your clients about how to maneuver in an inflationary environment where there still are opportunities?
Well, we're not sure exactly how that's all going to play out, and it will determine, how the health of the business is at the time once these tariffs, if they do go into effect. But, it depends. Are they going to keep it themselves if the health of the business is strong, or are they going to pass that along to the consumer? So that could have some inflationary impact as well.
When it comes to these small businesses, whether it's goods or services, who's feeling more optimistic?
I would say the services sector. We are seeing, services. We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. So people are spending on, memories. How do they take trips, and what are they doing that they can, continue to do? So we see that into the business segment. We're seeing an uptick in not only, travel and lodging, but also in other services, so professional services, finance. You are seeing an uptick in those businesses.
You say inflation remains a top concern, but even for small businesses, but even with inflation potentially lingering as this concern, do you see any appetite for consumers to slow down?
You know, we have seen a very steady consumer. And so as we look at our data through the consumer reports, we see that their balances are 30% higher than 2019. And so we continue to see strength in the consumer in all cohorts. And, you know, they are spending, and we've seen an uptick in holiday spending going into the holiday season. And so, you know, there's still strength there and still some dry powder.
You talked about how there is a willingness and ability to increase leverage. And you are seeing more borrowing, even though there is a bit of credit card debt already outstanding for some of these small businesses. Can you talk about how different that is than, say, a couple of years ago, when maybe the scars of the pandemic were hanging over businesses and they weren't as willing to borrow? How much do you expect borrowing to really increase?
Well, we are seeing increased demand. And as you think about the balances on card, we do see an uptick, and that's not only due to the inflationary pressure that's happened over the past year, but also capital expenditures. And so we are seeing that pull through, but we have a strong business economy. When you think about the credit and clients that are out there in the communities really rebuilding.
Can they handle interest rates where they are? Because we get conflicting reports about that. What do you see?
They are handling the interest rates where they are. And again, we are seeing today we'll have another decision on, and we expect another 25 basis point decrease in the rate. And so, you know, it will help as rates come down. I think it will be easier for consumers as well as businesses to
But you're not picking up on any stress at the moment. I think that's important.
We are not.
That's interesting, particularly when the Federal Reserve is going around saying they think they are sufficiently restrictive. At a time when we see markets at all-time highs, credit spreads super tight, and then you hear that on small businesses, that it's not killing them, it's not hurting that much.
And at the same time, they're actually even increasing their borrowing despite some of these rates. So you have to wonder, do you end up with that increase in borrowing even if rates stay around here? And that's one of the real key questions that a lot of people are wondering.
Sharon, super smart and good to catch up with you. Appreciate your time. Thank you. Sharon Miller there of Bank of America on small business lending and what's happening with those small businesses across America right now. Speaking of the fixed income market interest rates, yields a little bit higher today, up by 3 basis points. The 10-year 4.43, Lisa, the 2-year up to about 4.30 at the front end of the curve.
We've been talking about this. The reason why we have seen that uptick recently is because of this belief in stickier inflation, and it goes to exactly what Sharon is talking about, which is the key question will be passing along some of those increases in costs and the fact that a lot of these businesses can tolerate borrowing at levels that are currently in the market.
That Federal Reserve decision just around the corner. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. President-elect Trump says Ukraine needs to make a deal with Russia to end the invasion and downplay the value of occupied land. That may signal a Trump push for a settlement that codifies Russian territorial gains. Speaking at Mar-a-Lago on Monday, Trump again criticized the use of U.S. weapons to strike targets deeper into Russian territory. Pfizer shares moving higher in the pre-market trade by 3%. 2025 sales and revenue were in line with estimates, helping Pfizer fend off activist investor claims about mismanagement. It said sales next year will be between $61 and $64 billion. Shares year to date down just over 12%. People familiar tell us that Volkswagen's management and labor leaders are still far apart from a deal. After talks in Hanover yesterday, VW's CEO and human relations chief are set to tell the board that prospects of an imminent deal are dim. People familiar say today's negotiations are expected to go late into the night. A breakthrough must be made by early Wednesday, or the union will vote on walkouts to take place in January. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, big tech cozying up to Trump.
I had dinner with sort of almost all of them, and the rest are coming. One of the big differences between the first term, everybody was fighting me. In this term, everybody wants to be my friend.
It's a big difference, a big change. We'll discuss that next with Dan Ives of Wedbush from New York. This is Bloomberg.
you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
So here's the stock market picture. Equities down just a touch. We're down 0.33% on the S&P 500. Bond yields a little bit higher, up by 3 or 4 basis points. The 10-year at 4.43. Just to set the stage for the next 24 hours, in about 43 minutes, you'll get US retail sales. Then tomorrow afternoon, 2 p.m. Eastern Time, a decision from the Federal Reserve at a news conference with Chairman Powell 30 minutes after that. At the Savannahs this morning, big tech cozying up to Donald Trump.
I did have dinner with Tim Cook. I had dinner with sort of almost all of them, and the rest are coming. One of the big differences between the first term, everybody was fighting me. In this term, everybody wants to be my friend. I don't know. My personality changed or something. It's a big difference. The big difference is that the first time, everybody was fighting me. On all fronts.
It's a big change, and here's the latest. President-elect Donald Trump hosting a series of meetings with top tech leaders, including Meta's Mark Zuckerberg, Alphabet's Sundar Pichai, and Apple's Tim Cook. The incoming president sharing plans to meet with Amazon founder Jeff Bezos sometime this week. Dan Ives of Wedbush raising his Tesla price target to $515, writing, "We believe the Trump White House over the next 4 years will be a total game changer for the autonomous and AI story for Tesla and Musk over the coming years." Dan joins us now with quite a punchy price target. Dan, good morning. It's good to see you.
Great to be here.
Vijay Rakesh Mizuho doing something similar this morning. He makes a different point, though, and I'd love your thoughts on this. He says the new administration's policies, repealing the consumer EV tax credit, positions Tesla better than lower EV cost structure relative to peers. How important is that piece of the puzzle?
Well, I think that's important because, again, negative for the EV industry, positive for Tesla in terms of the scale and scope. But if you look, as they sort of do the sweep the leg on the EV tax credits, that's just going to give Tesla more and more of an advantage. But let's just be clear, that's the appetizer. I mean, the main event here, what we are focused on, the gold at the end of the rainbow, it's autonomous, the AI future. And I think that's where the light bulbs went off, because if you look at the Trump-Musk bromance, and as this all plays out, this is really going to be, I think, it's a poker move that I think will really be the bet for the ages when you look at Musk bet on Trump.
The vibes are good, and it's hard to fight against them. I just got a message from a Bloomberg subscriber. I won't mention their name. I believe you know the individual, and we can talk about that in the commercial break, and this is what they say. Tesla has increased since the election by something like 700 billion in market cap, now 1.5 trillion. The business is not growing and hasn't in 2 years. Despite the hopes of full self-driving, it still doesn't work, so less regulation doesn't help it work. It's up another GM in market cap this morning, or better, the market cap of Waymo, which actually has working robo-taxis. My prediction for 25 is Tesla will lose over $1 trillion in market cap. What would you say back to that individual?
I'd say if that person was an NFL scout, they're probably negative on Tom Brady, come out of the 2000 draft, come out of Michigan. I mean, the point is look, despite all the Super Bowls, look, if you look, the Bears, they can't see AI in the spreadsheets. So when they're sitting there in hibernation mode, they don't understand this move. Autonomous is worth $1 trillion valuation to the Tesla story, and I believe now, as this all plays out, it's really just the start. I continue to view this as probably the best pure AI play out there.
So I guess if you want to build on that, it might be that this person isn't looking necessarily at the same kind of $1 trillion addition to the market cap. But then if you spin that the other way, why isn't this promise also lifting the stocks of, say, GM, which, yes, got out of the possibility of robo-taxis on its homegrown turf, but is partnering with others to do the same thing and isn't being valued at all in that increase?
And look, I'd argue you look at Alphabet. I mean, Waymo, a big thing that we've talked about with Alphabet, the reason it's a table pounder, some of the parts, Waymo is going to be a huge benefit for them, too, when it comes to autonomous. But look, this is being led by Musk and Tesla. In the Mount Rushmore, they are going to continue to own this because you have 7 million vehicles out there going to 10 million. You look at GM in terms of the Cruise, that's a black eye situation. I ultimately think down the road, they could OEM technology from Tesla when it comes to autonomous and full self-driving. And that's why, you look at this beltway, the difference now is that Musk went from sort of the enemy to now he's going to have a game. It's a game changer relative to the federal regulatory landscape that I think Musk could help change.
Just to crystallize what you're talking about, some people say he invested $277 million in Donald Trump's campaign, and he gained his net worth $200 billion in the process. It seems like a pretty good financial trade. There is a larger question here about FSD, and this question of, are we better off with a market leader because of a status, not only just simply because of their technology? To the writer's point, there have been pitfalls in the full self-driving technology for Tesla. There have been accidents. There have been some real questions around whether it's ready to go. How much does it make the system more fragile to roll it out at a time where there is one entity with such favor?
Yeah, sure. And I think, again, this is going to be rolled out in a staged process. And our whole view is just, when you look at now the new landscape, it's going to give Tesla a much greener pasture when it comes to autonomous over the coming years. And I ultimately believe Cybercab, is that what we talk about robotaxi today? This is going to accelerate that vision and make it real. And Lisa, I think the other thing is that when you look at Optimus and you look at robotics, as we've talked about in the show, that's not even factored in from a valuation perspective. I continue to view overall, in this AI party, it was 9 p.m., but now it's 10 p.m., The party goes to 4 a.m.
I'm usually in bed by then.
But party goes to 4 a.m. And
Just
now,
for the record.
behind those velvet ropes, now you let software in. Benioff, let him in. You have other software players coming in. Others are going to get on the party, but it just goes back to where I believe we are going in 2025.
All right, but to bring back up the point of the Debbie Downer viewer that's writing in about what you have to say, you're really talking about a vibe. But where is the technology right now? How much longer do we need to wait for this type of technology?
I think a year from now, we're talking about, when it comes to autonomous and it comes to FSD, when you think about where we need to get the FSD penetration above 50%, I think a year from now, we'll be there. And I think a big blockade here has been the regulatory spiderweb in the Beltway. Look, as we always say,
the spiderweb won't matter if the technology is not there.
But I believe the technology has advanced significantly. If you look right now, if you look at V13, you look at what they've been able to do. But look, haters continue to hate.
Don't look at me.
No, look, and the point is, like, they hated 100 billion, right? Hated 500 billion, despise it $1 trillion. At 2 trillion, they'll be yelling from the mountaintops. But it goes back to, like, just like in broader big tech, This AI revolution is here. It's a 1996 moment, but it's not a 1999 bubble moment. And Musk and Tesla are going to play a huge role in terms of what we see the autonomous.
There's another name I want to squeeze in before you go. You've talked about it a lot. Palantir. Why doesn't that get talked about more? The run it's seen so far in 2024.
It's the Messi of AI, right? I mean,
it's up 350% this
but
year.
I believe it's, to me, it could be ultimately the next Oracle, the next Microsoft. And that's why, look, the haters, they hate it as a teenager, despise it as a senior citizen living in Delray Beach. So that they hate it at 13, despise it at 75. But I believe it's just the start of when it comes to AI revolution, this is the best use case. Carp is up there in that Mount Rushmore, along with Godfather of AI, Jensen, NVIDIA, Nadella, and others.
What's Carp doing right?
Carp understands, I think, AI use cases. The algorithms they built are unique. And there's no other, I think, there's ultimately AIP, there's no other software that matches them. And I think Palantir has one institutionally been shunned. Retail clearly has been, I think, a bit ahead. Just starting in terms of our view of the broader Palantir story. But as I always say, the bears, they can find AI in the spreadsheets when they're in hibernation mode.
Dan, it's good to see you.
Great to be
Dan Ives of Wedbush. I'm not sure about the Tom Brady Michigan comparison with a market cap of 1.5 trillion, but you know, I'm not sure that works.
Look, it goes back to just early days, right? In terms,
Okay.
but again, bears can see the greatness.
Bryce Young, Alabama, Heisman winner, like that kind of works. Bit overvalued.
I would say it's somewhere.
Didn't work out.
Again, and Bryce Young, don't count Bryce Young out, too.
I like Bryce Young.
Yeah, I'm actually bullish on Bryce Young.
Yeah, I hope he makes a comeback. Mike Wilson of Morgan Stanley up next. It's good to see you, Dan. Thank you. The JetBlue CEO, Joanna Geraghty, Lorena Urucci of T. Rowe Price, and Amanda Lynham of BlackRock in the third hour of Bloomberg Surveillance. Up next.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people are optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if people don't, if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Going to present risks that, other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
I think growth has surprised to the upside since the election. It's just harder and harder to justify owning non-U.S. developed markets.
Returns have really been driven by a narrow collection of stocks. Narrow stock leadership is fragile stock leadership.
There's clearly this awakening of animal spirits. The attitudes from the sell side today are remarkably different than they were a year ago.
There's enormous optimism about the U.S., but we don't know about what this new administration is going to do.
Sentiment is very positive, but I think sentiment is positive for a reason. You know, the economic growth's been surprising to the upside.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with a snapshot of the price action going into the opening bell in about 90 minutes' time. Equity futures on the S&P 500 negative and near session lows. We're down 0.4%. Underperformance once again on the Russell. Small caps down by 0.6. In about 29 minutes' time, retail sales in America, the last big data point before the Federal Reserve meets. That meeting a little bit later on today concludes tomorrow afternoon at 2 p.m. Eastern Time, and then we'll hear from the man himself, Chairman Powell.
A lot of this comes down to what they signal for 2025 at a time where people think the economy is doing pretty well. Yesterday's services PMIs came out much better than expected. It raises this question: at what point will the strength of the economy translate, maybe not into much lower rates, but at least into the broadening out in some of the equity trends that we haven't seen over the past couple of weeks?
Andrew Hollenhorst just publishing, talking about resilient consumer spending. We spoke to Sharon Miller of Bank of America talking about even with a little bit stickier inflation across some of the sectors, they are still seeing consumers going out and wanting to spend. The resiliency of this consumer, which brings you to the Wall Street Journal editorial board this morning that is saying, why, Jay Powell? Why are you hiking yet again, cutting yet again? And this would mark a full 1 percentage point reduction when you see how financial markets have already reacted, how the consumers are already reacting to your previous cuts.
Financial markets sky high, equities at records, credit spreads super tight. We talked about triple C's, the junkiest of junk have seen a huge rally since the summer. Embrace the bubble. The message coming from Barron's over the weekend. Then you look at sentiment from the Bank of America Global Fund Manager Survey. Cash levels, record lows.
Yeah, 4%, which they said is the second contrarian sell signal at a time when people can only come up with reasons to sell, like everybody is bullish, so I feel worried. There is a feeling where it is hard to understand what the sell trigger will be without that sort of catalyst from some sort of external event. At the same time, I do think it's notable that we're not seeing the broadening out. I am worried about bad breath.
Every single day so far in December continued yesterday too.
11 days that there are more losers than gainers. That is the longest streak in about 40 years. You're looking at this and wondering, what are people on the ground from the bottom up worried about that people from the top down just aren't?
This from Bank of America. Bubbles can last longer than you can stay underweight. It's been painful to be bearish through 2024. Coming up this hour, we'll catch up with Mike Wilson of Morgan Stanley as tech stocks hit another all-time high. JetBlue CEO Joanna Geraghty on the demand for premium travel options, and Amanda Lynham of BlackRock on the Fed's rocky path in 2025. We begin this hour looking ahead to U.S. retail sales at 8:30 Eastern before the last Federal Reserve decision of 2024. Mike Wilson of Morgan Stanley seeing better balance for next year, saying we see more balanced EPS growth in 25 for the S&P 500. This should lead to better breadth, something that has been absent over the last 2 years. And Mike Wilson absent over the last few weeks. Good morning. What's happening?
Well, this is the debate, right? So I think what's happened is we got the broadening out in the fall on three things. A, we priced out the recession risk, which was kind of creeping into markets. The Fed went 50, which, was a surprise and maybe not even necessary. And so that got people juiced up. And then, of course, we had the election. And I would say the election was positive for two reasons. We talked about this last time. One, we got a Republican sweep, which markets tend to view more positively. But more importantly, it was definitive. And so a lot of those hedges came off. And those hedges were in some of the lower quality areas. And so I think that kind of basically pulled forward the initial move on the broadening out. And now what's happening is because rates are back up, there's some concern about the Fed not being able to cut perhaps as much as people thought. And so we're seeing a de-risking kind of into year end, or just some profit taking, quite frankly. So we'll see. I mean, look, when you read the note, but I mean, we said we think there's a broadening out. That's not what we think. That's what the consensus thinks. Okay, so in other words, that's the expectation. If the consensus numbers are hit next year, bottoms up, we will see a broadening out. That's the key. It's about earnings revisions, and we're just being a little more selective on that. So we upgraded, financials. We've been more constructive on software, some of the industrial names, because of the earnings story. And that's how we're going to trade this for the next 3 to 6 months, is we're going to look for the areas where revision breadth is improving. It's not going to be universal. This is not like coming out of a new cycle. So I want to make that perfectly clear to listeners that we're not expecting a broad rally in the way like 2020, 2021, where the low quality stuff, everything goes up. It's going to be more rifle-shotted to the areas where growth is improving.
Let's sit on that distinction. It's not a new cycle, it's a late cycle extension. That's what you're calling it.
That's right.
Why is that so important? What's the difference between the two?
Well, we're getting what we usually get. We called it classic late cycle back in 2017. It's actually the most bullish part of the cycle because the Fed is moving, multiples expand. So let's just talk about what happened over the last 12 months. It's exactly what's happened. Earnings estimates have not gone up for 25 and 26. They've just rolled forward. Multiple went from 17 times to 22 times. That's very typical in the late cycle period. You typically get narrowness, which is what we're getting right now. The quality stocks have continued to work with this back and forth, this uncertainty around, is it a hard landing? Is it going to be a reacceleration of growth? Is the Fed doing enough? Are they behind the curve? Are they ahead of the curve? And that creates these really opportunistic rotations.
How much is this late cycle trend turbocharged by the idea that there is no alternative than the United States right now?
Well, that's a very good point, Lisa. I mean, we wrote about that in our last note about a month ago, or that monthly note that we put out, just saying, we were in Singapore talking to investors all over the world. There's just no interest for anything except the U.S., this U.S. exceptionalism idea. I think Trump winning just makes people, it's like a magnet, because it's like, they're just going to put all their resources now internally. And so that helped. And I think that's price. That's what the markets are saying. Okay, the markets are basically saying that's correct. Now, is it overpriced? Potentially. I mean, clearly in some stocks and sectors it's overpriced, but that move is not wrong. I think the markets, I think investors are just seeing what's right in front of them. They're saying that America is going to take share. America has this America First agenda.
When you talk about a sort of rifle shot, you have to look at the areas of growth, and you've talked about the rotation in themes, and that this is a market searching for a new theme other than AI. And I'm just wondering what's on your bingo card in terms of the theme that's going to pop up next that could be really transformative for investing trends.
Exactly, and so we're trying to find areas that have not yet recovered from what I would say we've been in a 2 to 3 year recession now. In the private economy, we've been in a recession in housing, manufacturing, IT spending away from consumer goods. So there's been a lot of things that have been beaten up. So we're looking for the next thing where there could be a reacceleration. 2 areas that look interesting. We're not there yet. Consumer goods, where inflation actually maybe is picking up now, which is actually good for earnings. And the second one is transports, which have been in a depression, because there's been no restocking. There's been no kind of pull forward. And so if animal spirits come back, those are 2 areas where we think there could be life. Now, like I said, we're not there yet because we haven't seen a revision breadth bottom out, but those are on our bingo card.
But on the flip side, what is potentially others you can see in this move into maybe depression mode?
Well, I don't think there's a depression. But there are areas that are probably going to see a deceleration. So, for example, semiconductors have been trading terribly, mostly because they're in a deceleration now, except for a handful of stocks really benefiting from AI. I mean, if you mention AI, you benefited, but the reality is it's a handful of stocks that have actually seen that spending increase. And the traditional semiconductors actually got bid up on that idea, now are selling off in memory and analog, some of the more commodity areas. So that's actually happening right now. I think we're going to see some of that maybe in consumer services, where we're seeing a deceleration in inflation. Now, a little adage that I think people don't appreciate is, average stocks do better when inflation's accelerating, right? Because that's their pricing power, that's earnings growth, that's 2020, 2021. And we've seen this divergence between consumer goods and consumer services, where services have had pricing, goods have not. And now, if you look at some of the data in the CPI, which I know you follow closely, we're seeing services decelerate and goods are actually starting to bottom out. They're still negative, still seeing deflation, but that's starting to turn up.
When it comes to the most bullish catalyst for next year, the Bank of America Fund survey talked about China, reacceleration, AI productivity gains, a peace deal in Ukraine, and U.S. tax cuts. What do you think would be the most bullish?
Well, I think U.S. tax cuts are kind of off the table in terms of incremental. Now, I could see an extension of what we've gotten, and that's sort of just, I don't think that's an incremental positive like it was in 2017. So I take that one off.
Status quo.
Yeah, I mean, if they don't extend it, then it's a real negative. I think that's the way I think about taxes. I would say on the peace deal, I mean, that's, okay, I mean, yeah, we're all hoping for that. But I'm not sure there's an investment opportunity in that. I mean, like a lot of people are bullish on defense stocks, so maybe that actually peels off. So that could be somewhat of a negative for certain areas. I would say that, the productivity thing on not only AI, but productivity in general. I mean, are we going to get more productivity out of people? Because, we're not allowing as many immigrants in anymore. We need to find labor productivity. If we don't get labor productivity, that's going to be a real headwind for businesses. So I think that's a big one. Some of it's AI related. Some of it's just getting people more efficient. Look, people are still getting back to work in the office place, quite frankly. You know what I mean? I mean, the one that I would put on
federal government.
Yeah, when I would put on the card, and this is more of a 26, 27 story. Can we get more efficiency out of the government employees who are not bad workers or bad people? They're just maybe playing for a bad team. We talked about this last time. Can we get those people repositioned in the private economy as the private economy now is starting to recover?
You said something that I want to pick up on, that companies tend to do better when inflation is accelerating. And this kind of flies in the face of what a lot of people are expecting for next year, that the disinflationary environment is going to be a Goldilocks nirvana for equity valuations. How much is, if the Fed gets what they want, and if we actually do see disinflation, that could be one of the bigger risk cases to equities that have benefited from an acceleration in inflation that has given them pricing power?
Totally, multiple will come down. Okay, so I think this is an index risk, and we, I've been thinking about this for a while. So we had this rally in from the summer where the average stock did better, right? Look at just say S&P equal weight versus market cap, and that was a pretty powerful rally. It's giving up almost all those gains now, and it looks to me like we're going to make a new low in that ratio. Like we're going to retest the lows in the first quarter, meaning index market cap is better than equal weight, and that's the low that I want to buy. Now that could mean that maybe inflation is stickier, that pricing is better, earnings end up being broader, okay? And you see a rotation where the average stock does better than the index. Now that could also mean an index level correction of 10 whatever percent plus, but that the average stock does better. Same thing, by the way, happened in early 2000. So it's a very similar setup where 2000 was a great year for the economy, okay, but the index came down because the high flyers came down as rates went up, and the average stock actually did quite well. So that's an interesting kind of thing that we're looking at. I think it's too early to do it now before year end, because this is kind of monkey time for the last 2 weeks of the year. I mean, people are just,
What's monkey time, Mike?
Monkey time is
This
basically,
is monkey time.
Yeah, I mean, we're
sort of like
marking up
messing around.
positions, like it's just, everybody wants to get to the holiday. I mean, so no one's really taking big bets right now. That's my point. And I think that the first quarter could be interesting in this regard.
Correction in NVIDIA. We're down by a little more than 10% off the highs in early November. What do you think is going on there?
Well, I mean, there's a deceleration going on, right? I mean, gross margins peaked earlier this year. We're seeing a deceleration in growth, still very robust, okay? This is not like a situation where they have a problem. It's more of just that, hey, this thing priced a lot of good news. It's kind of gone sideways since the summer. It's digesting that. We're seeing a rotation into some other AI winners. That money's moving. That's normal. I don't think there's anything nefarious with that.
Mike, appreciate your time.
Great to see you.
Enjoy the monkey time. Into the weekend. Mike Watson there of Morgan Stanley. Equity future session lows, we're down by almost 0.5% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ukraine claimed responsibility for the assassination of a Russia general in a bomb attack in Moscow. According to people familiar, Ukraine's security service carried out the killing of Lieutenant General Igor Kirilov and his assistant. Russia said the two servicemen died when an explosive device planted on a scooter detonated near the entrance to an apartment building. Investigators have opened a criminal case for murder. Israeli officials say a ceasefire agreement with Hamas is more likely than it has ever been over the past year. A working group from Israel is in Doha this week, reestablishing relations with mediators. Details are mostly under wraps, but two Israeli officials said the ceasefire would occur in stages, the first of which would be to free hostages that are women, ill, and older than 51. The CEO of TikTok met with Trump at Mar-a-Lago yesterday, just weeks before the popular video app is expected to be banned in the U.S. over national security concerns. The private meeting came just hours after Trump suggested he'd somehow try to reverse the ban to save TikTok, which he used to reach young voters on the campaign trail. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the morning calls. Plus, we'll catch up with the JetBlue CEO, Joanna Garrity, in just a moment as consumers continue to splurge on premium travel. That conversation up next.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures on the S&P down about 0.4% on the S&P 500. Bond yields higher by 3 basis points. The 10-year 4.43. Let's get you some morning calls. First up, Mizuho upgrading Tesla to outperform, citing an improved outlook under the incoming Trump administration. That stock is up by a little more than 2%. Your second call from Jefferies downgrading Match Group to hold, pointing to weak revenue trends for its Tinder app. That stock is down by 1.8%. And finally, Telsey Advisory upgrading Albertsons to outperform, highlighting growth potential following the termination of the Kroger merger. That stock is up just a little bit by 0.75%. Turning to consumer spending, JetBlue planning to expand its first-class offerings in 2026 as passengers continue to pay up for premium options. The carrier also cutting capacity to increase fares and focus on East Coast leisure destinations. Joining us now to discuss is the JetBlue CEO, Joanna Geraghty. Joanna, good to see you.
Thanks for having me.
The demand for premium is through the roof, and a lot of people are trying to provide the capacity for it. What gives you the impression, the confidence that that demand's going to stick around?
I mean, JetBlue's been doing premium for 10 years. We introduced our Mint product 10 years ago. This is just continuing to round out the suite of products that we have. We have a great coach experience. We have even more space, Mint Lie Flat, and now more of a domestic Mint, domestic business class seat that we're going to be introducing in 2026. Very excited to bring it to customers in leisure markets.
Food is best in class. I'll say that on your behalf.
Thank you.
I've done the flight in Mint to California and to London as well. Where does that come from? How expensive is it to provide that kind of product?
Yeah, I mean, we really look to provide a differentiated experience, and we lean in on certain areas. So food has been an area that we focus on. Comfort is another area that we spend a lot of time with. We have a great partnership with Tuft & Needle, and as we think about our new domestic first class, comfort's going to be the area that we lean in on there as well, with some interesting features of our seat product that provide a bit more comfort to customers.
How difficult is it to thread a needle with the likes of business class, given the fact that JetBlue traditionally has been an airline that caters to pleasure travel, to the idea of traveling with the family to warm places in the wintertime? How much does that kind of create a conflict for you?
You know, we don't think it creates a conflict because everybody's a leisure customer. And when you think about what you like to do on a vacation, sometimes you want an elevated travel experience as well. So we want to make sure that we have an offering for every type of leisure customer. One of the things we have done recently is kind of retrenched in the Northeast, really focusing on serving the best leisure markets out of the Northeast, Europe, the West Coast, down in the Caribbean. And there's a real market for that premium seat.
I guess another way to say this is businesses are willing to pay more on their expense accounts than individuals, especially when they're going on vacation. How difficult is it to charge the rates that make it worthwhile, given the fact that it's people going on vacation and they typically have budgets?
We're not focused on charging rates that are akin to what a business customer in a business would charge. We really want to make the premium experience affordable to leisure customers. When we introduced Mint 10 years ago, we did just that. We reduced fares to the West Coast. We introduced a better product, a better service, and that's what we're looking to do here. It's really important for JetBlue to make sure that we have affordable fares and that all of our products are accessible to the leisure customer. So that's the customer that we're targeting. Somebody willing to pay a bit more, but not at the size that you would for a business.
You've been tasked with turning around the balance sheet of JetBlue, and you've made progress in that front. You just reported earnings that were positive and really pointed toward progress in that. How much are you able to raise prices at a time where you see increasing consumer pushback But at the same time, there seems to still be that ongoing demand for travel.
There's very healthy demand in the peak, and that's where leisure travel is great. So as we think about, the holidays, we think about the summer time frame, that's where I think JetBlue does its best, because we fly to some of these great destinations. Troughs are definitely more challenging. We've seen some pricing pressure in the troughs, and we've reduced a lot of flying in the troughs. So it's really about balancing out that year and making sure that, when demand is high, you're focused on trying to capture your share of that demand, and in the troughs, really reducing the losses.
So do you expect to increase fares this year?
We're hopeful that we can keep fares affordable that reflect the cost of service. It's more expensive to travel now because there are costs. Airport costs have gone up, labor costs have gone up, so there's meaningful inflationary pressure for the airlines as well. Our great food comes at a cost. When you start seeing the grocery costs go up, that means the food in an aircraft is going to go up too. So we're really trying to balance it and make sure that relative to the other travel out there, that JetBlue is an affordable fare for customers and accessible for a leisure customer.
Well, there's also been other constraints on the airline industry when it comes to getting the parts they need, comes to actually getting the planes they need to fly. And then next year, a lot of people are talking about, well, we might get tariffs, and potentially that might impact the supply chain. How are you preparing for all of that?
Yeah, I mean, JetBlue has a unique situation with Pratt & Whitney right now, and we have a number of aircraft sitting on the ground that we're paying for, but we're not able to fly because they're due for an engine inspection, and there's not enough capacity to do those inspections. So that's definitely a headwind for JetBlue. As you think about tariffs, it's a bit too soon to tell. I think the good news for JetBlue is we take a lot of our aircraft from Alabama, but depending on how tariffs get put in, we do have exposure in Europe and in Canada because some of our aircraft come from there.
Of course, the JetBlue Spirit Airlines potential merger was blocked. Are you potentially thinking about going at it again in the next 4 years in this space, more mergers and acquisitions, because there might be a lighter regulatory touch in Washington, D.C.?
We're really focused on delivering our new plan, JetForward. We want to see JetBlue thrive as a successful standalone company. We have a brand that customers love. We've got a great product, a great service. We're focused on flying in the places that people know us. So we're really focused on our standalone plan, JetForward, right now.
Okay, so you might not dip your toes back into that space, but do you think that this is going to be a more welcoming administration when it comes to things like mergers and acquisitions?
It's hard to speculate because we don't know exactly what the kind of plan is going to be, but it's hard to see an administration that's going to be worse than the administration we had around antitrust.
In the meantime, you have announced a number of changes in terms of the JetForward, including closing down certain operations in a number of cities. I believe that they are going to cut, you're going to cut some 50 routes.
Correct.
Is it done? Are there more to come?
The network is always something that's evolving, so the majority of the changes are done, but we're not going to rest on our laurels. If a particular market is not producing results, then we're going to take a good hard look at it, see if we can improve it, and if not, then we're going to point those planes to a place where we can make money. We've got to become profitable, and part of that has made the need to make some tough decisions.
I've got to follow up. Have you spoken to the incoming administration?
We have not spoken to the incoming administration.
You're planning to go down to Mar-a-Lago anytime soon and make the pilgrimage?
Right now, I'm focused on holiday travel. We have 150,000 customers a day flying on JetBlue.
Palm Beach is a great place
over the holidays.
For the sun for the holidays.
You can combine the two. What do we call that?
Yeah.
Workations?
Leisure.
Pleasure?
Leisure.
Bleisure.
Yeah,
Bleisure. Okay, bleisure. You sing a lot of bleisure?
We see a lot of leisure. We see a lot of leisure over the holidays, too, though. And we're just really happy to be a part of connecting people with their families over the holidays.
What does the volume look like
About 150,000 people a day over the Christmas holiday. We've got about 1,000 flights a day. And, it's amazing when you think what airlines do and the magic that we can deliver to customers reuniting their families and making that great experience. It'll be busy. It'll be tough. And my hope is that everybody can be patient and a little kinder.
If you're asking for patience, does that mean there are going to be delays? How does this stack up?
Oh, you've teed that one up perfectly. Delays. I wish this administration would focus more on air traffic control. That has definitely been a meaningful pressure to JetBlue, to all airlines. When we think about this next administration, that is a real focus area for JetBlue.
What would you like to see change? What can they do?
I would love to see more hiring. I'd love to see better technology and ultimately improving the amount of delays that come out of the air traffic control system in New York in particular, which is the hardest hit.
We'd all like to see the same thing. No one wants delays, do they, Bramo?
You're talking to the choir. I've had, okay, honestly, going to Florida is the hardest, though. I have to be honest, because there's always weather. There are winds that come up. There's a random storm that comes up. And some people get delayed for a long period of time, and they sit there, and then their plane gets canceled, and they can't go on vacation with the whole family.
Or CEOs can't control the weather, though.
Okay.
But what is interesting is we have here an airline CEO saying they want the FAA to hire more. And the incoming administration is talking about dogifying the government.
It's true.
Well, hopefully they're not talking about air traffic controllers. We are grossly understaffed. And at the end of the day, those delays, even with weather, we should be able to have a more resilient aviation air traffic control system with weather. That is just something that we have to deal with.
Just pause for a second. Are you saying that all those delays, it's not because of weather? It's just
no,
because
some of the delays are definitely because of weather, but they are exacerbated because we are significantly understaffed among air traffic controllers.
I never trust the excuse. You've got a problem with trust as well. I never trust them. I never trust them.
I know what's actually going on. And actually, to Joanna's point, there is a problem with air traffic
The staff's missing
But
or
sometimes
something.
you can actually see how bad the weather is, and you're thinking, I
Sure,
would wait
and it's
for
the
that.
weather. But sometimes you look outside, the sky is blue, the sun is shining, and they're like...
Air traffic control delays.
Yeah.
That's a
Come
problem.
on. The pilot's missing, went out the night before, who knows?
That's in Japan.
That does not happen.
That was wild.
Doesn't happen
That
at
does not
JetBlue.
happen at JetBlue.
Just to be very clear. Okay. Joanna Geraghty, it's good to see you.
Thank you.
Appreciate your time. Thank you. Up next on the program, we'll break some US retail sales. Those numbers drop in about 5 minutes' time. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
significant data point is just seconds away. US retail sales in just a moment, about 20 seconds away. Going into that data, equity futures on the S&P, negative by 0.4%. On a Russell, we're down by 0.5 in the bond market. Bond yields shaping up as follows. 2-year, 10-year and 30-year yields higher by 2 or 3 basis points. The 10-year 442.44. With your economic data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Let's call up the numbers here. They're just coming in stronger than anticipated. It looks like we had a pretty good November off the top here. 7/10 gain as opposed to a 6/10 forecast. That's up from a 4/10 gain the month before. And then in terms of ex-auto, up 2/10. That's lower than anticipated. Retail sales ex-auto and gas, 2/10 lower than anticipated. So it looks like a lot in the gas and auto range in the advanced number. Now, the control group is what we care about. It's what goes into GDP, 0.4%. Bang on with the forecast, and it is better than the 0.1% decline that we saw the month before. We'll take a look at the categories here as you check the markets.
Mike McKee, I'll turn to the bond market first. The move just fading a touch. We're up a single basis point now on a 10-year, likewise on a 2-year. So let's call it 426 at the front end of the curve. In the equity market, we were near session lows, down by about 0.5% on the S&P, recovering a touch. We're down by 0.4. So the headline comes in at 0.7, at least, so the estimate was 0.6. The revision is pretty decent. Control group comes in line.
Basically, we're looking at what looks like a distortion a little bit, particularly from auto sales. If you look just ex-auto and gas, that actually came in below expectations. I'll let Mike actually parse through the numbers. I will say the upside surprise, though, the upside revision is interesting to me. Things look better even than people previously thought, and this is part of the give back that people were expecting from the hurricane that we saw. But it was even better than people expected. Again, better than expected economic data is the theme of 2024.
And Mike McKee, take the opportunity to have a second look. What do you see in the details?
Well, it looks reasonably strong throughout, which is why the core is up. It is definitely distorted by autos and other motor vehicles. The advanced number for auto parts and autos is 2.8% gain. That is reasonably strong. And gasoline prices on the month were up 1/10. We have seen declines in that category for many months, and now we get a rebound there. But other than clothing stores and general merchandise stores, most everything is up. Clothing stores were down 2/10. General merchandise department stores down 0.6%. Food services and drinking places, interestingly, off by 0.4. That's usually seen as the one discretionary category here, and it is the only services category in the whole thing. But furniture up 0.3, electronics and appliances up 0.3. Building materials up 0.4. Now, we knew that would probably be higher because of the hurricanes rebuilding. And grocery stores down 0.2. So a real mixture here. Some strength in areas that you might be expecting, and then some declines in areas that would be related to the holidays. Let's see how it all turns out in December once people get to really shopping.
Mike, has there been a trend, I mean, aside from some of the hurricane disruptions, of increasing demand and increased spend on the goods sectors, on furniture again, on home improvement, on cars, on areas that saw pretty significant disinflation and even deflation over the past year?
Well, we have seen sort of change in that more people have been buying goods. Goods spending is up according to the government figures that we had a couple of weeks ago. But does that continue? Is it really the hurricanes? Because you see a lot of cars sold when hurricanes and other natural disasters happen. People still got to get to work. They know their insurance money's coming in. They go out and buy cars. And of course, you've got the rebuilding in the home builders areas. What's interesting is that we saw a 9/10 rise in sporting goods, hobby and bookstores, which is the strongest one for the month here. And yet, department stores were down 0.6. So maybe we are getting more goods than soft goods this year.
Mike McKee, thank you, sir. Stay close. We'll go back to Mike in just a moment. Looking at US retail sales, if you are just joining us, they come in at 0.7% for the month of November. That's the headline read. The estimate in our survey was 0.6. The revisions are positive as well. Joining us now to discuss is Blarina Urucci of T. Rowe Price. Blarina, welcome to the program. I want your opinion as to why people expect the Federal Reserve to cut interest rates tomorrow when the data seems to be pretty decent and equity markets are sky high.
I think the answer to that question is fairly simple. There is a degree of inertia within the institution. They started the easing cycle. It would look quite challenging to stop halfway and before they think they have gotten to a neutral rate of interest rates. And then I think let's talk a little bit about this idea that the Fed has, that the level of interest rates right now is very restrictive, and therefore, in order to manage the soft landing, we need to keep easing monetary policy. The information we got today from the Core Control Group retail sale points to a very resilient U.S. consumer, and we keep getting surprised by this resilience. But if you look at the labor market, that's supportive for the consumer. When you look at the equity market and the wealth channel, that's supportive. You have home prices that have not lost value, and then you have the stock market doing well. And then, but those have been sort of with us for the last year and a half or so. What's also new this year as a tailwind is that with inflation coming down, real disposable incomes are also supporting the consumer and consumer spending. So then I'm quite curious to see what this latest estimate of retail sales does to the GDP tracking for the Atlanta Fed, the GDP now, because that was tracking about 3.3% before this morning's release. Now compare that with the Fed's estimate of potential growth, which is 1.8%. The U.S. economy has been growing at about 3% throughout this year, which is significantly above estimates of trend growth. So that, and then the Fed thinks that neutral rates are below 3%. Something has to give. It's either growth potential is stronger or actually real interest rate or neutral interest rates in the U.S. economy are higher. And I think this is what the Fed will have to grapple in 2025.
Blarina, one of the reasons why it's been so confusing is it's not one story, right? It's the goods story, it's the services story, it's the high-end retail consumers, and it's the low-end retail consumers. Do we have a sense, just looking at the retail sales numbers and the retail reports that we've gotten over the past few weeks, do we have a sense, Blarina, about whether the spending right now is strong because of wealthy consumers or whether it's broadening out in terms of who is spending money and who has that capacity to do so?
And this is a very interesting question, and we have had this continuous rebalancing in the economy. We overstretched in terms of goods spending immediately post-pandemic. Then we had some payback in goods, and then growth shifted towards services. And I think in every report you will find outliers. You will find something that was driving retail sales higher and then is going to reverse the next month. But then what we see is then the following month, some other category is bouncing back up. So I think we take a step back and look at the data in aggregate. I think the U.S. consumer continues to spend, and a lot of that is not even coming from leverage. Now, we've had pockets of weakness, and I think affordability for the lower-end consumer has been a challenge. What seems to be different in this economy is that job availability and vacancies in the labor market have been so high that people have been able to find and add hours to their work week, and I think that's been quite supportive across the board.
Blarina, then what does this mean for, I mean, Jonathan opened up asking why should the Fed be cutting? Do you think there's a chance that we'll have more individuals dissent on this idea of cutting in December?
I think this is possible, but it's not my baseline. The one dissenter in the September meeting, Governor Bauman, she was dissenting on the principle that we shouldn't start the easing cycle with such a big bang, but I think since then she's fallen in line with the rest of the committee. I do think that Chair Powell wants to show a united front, so there might be a compromise here where they go ahead with rate cuts this week, but then they signal that they slow the pace of easing. And so that's giving reassurance to the hawks that they will respond to data as they come along, and they will have more time to decide whether a cut is appropriate in January or March or at the April-May meeting. So I think my baseline is that after December, the Fed takes a pause at the January meeting, and perhaps they shift to an every other meeting schedule. But if the data keeps coming strong as it's been in the last few months, there is a possibility that this becomes an extended pause.
That seems to be the consensus view going into 25. Blarina, we've got to leave it there. Blarina Urici there of T. Rowe Price. Lisa, this is a conversation we can't have with guests, so I'll have it with you. At some point next year, some people on this committee start to audition for Chairman Powell's job.
Basically, there's this expectation, come 2026, Chair Powell is not going to be there. That presents a problem because this is a Fed chair who has tried to really maintain, I don't want to say control because that's not fair, but true leadership in terms of saying, okay, guys, we're now doing 50, everybody get on board. And so how much does that really start to see a splintering? Although, really, you have to kind of think they'd have to want to outdove everybody else.
Well, I already heard from a viewer today who said they can't believe that we've not heard from the Trump transition team, and maybe we will after the Fed does this cut, that all of 2024, before Trump sets foot into office, the Fed will have cut 3 times, and potentially they're talking about not touching the cut lever in 2025.
These changeovers are important. If you remember, they started the hiking cycle quite late. And there was a former official of the committee who suggested that it was because they hadn't decided the leadership of the Federal Reserve, that they were dragging their feet on hiking interest rates all those years ago. So I think these things matter over the next 18 months.
Are there people who are going to hinge their decisions based on the political favorite Mike Curry or not? Chair Powell, I would argue, probably won't do that again, considering that he probably will not be up for re-election in 2026.
Mike McKee has plenty of things to say. Mike McKee, the consensus view into tomorrow is cut interest rates. Into January, it's skip. Does that line up with the communication that you've heard from Fed officials over the past few weeks?
The first part, not the second part, John. The Fed officials made pretty clear going into their blackout period that they were willing to cut this time. They feel they are restrictive. And if you look at the underlying credit issues, credit charges in terms of like credit cards, car loans, home loans, they are barely down from when the Fed started the cutting cycle. But do they pause in January? It's a really hard question, and I'll give you a good example here. We're looking right now at a November number that isn't very good for department stores and people like that, and is very good for non-store retailers, up 1.8%. But Black Friday was the last Friday of November, and Cyber Monday actually took place in December, thanks to Drew Mattis for pointing that out to us. And if that's the case, then these numbers aren't really telling you anything about November, and it's really hard to know what it means for the economy. And if I don't know, the Fed doesn't know, we're all going to wait until we get into January and get some more numbers before they will start to lean in one direction or another.
People like Drew are selling bonds again. Yields are up by 3 basis points, 443 on a US 10-year. Mike McKee, thank you, sir. Going into that Federal Reserve meeting a little bit later on today, and of course the decision tomorrow afternoon. Joining us around the table, Amanda Lynham of BlackRock. Amanda, it's good to see you.
Good morning. Thank you.
You've said this a few times, and I'm so pleased you say it on repeat. Growth is key here.
Yeah.
If the Federal Reserve is skipping because growth is good, great, I'm buying credit. If it's because inflation is sticky, I might have to have second thoughts. Is that how you think about 2025?
Absolutely. The one thing that we'll be watching for at the press conference is what happens to the committee's estimate of the neutral rate. I think that's really what's key into 2025. We've already had a range of commentary from Fed officials about maybe we're not that far from neutral. And that is something that I think will just determine the landing zone of where we end up. But to your point, if we land at a structurally higher level of rates, because growth is, as Blarina said, well above trend, that is a backdrop that corporate credit can digest, and actually that translates into a really positive technical tailwind on yield-based demand. But if it is because inflation is reaccelerating, and especially if that scenario would be coupled with weaker growth, that's a much more negative backdrop for credit.
In the equity market, valuations, forward multiples are elevated. A lot of people would come on the equity side of the story and they would say that's kind of meaningless going into next year. It doesn't have to mean anything for the performance of 2025. Are there more difficult reasons to say the same thing about credit?
I think at a high level, we would characterize it as our title of our outlook is cautiously optimistic heading into the first quarter. There's an opportunity cost to being materially underweight corporate credit risk. We saw that in 2024. 2024 was a rally led by the lower quality portions of the credit market. I just think you need to be very clear about why you're buying credit in 2025. We're recommending to investors, buy it for yield, buy it for carry. Don't buy it because you think spreads will tighten materially, and don't buy it because you think rates are going to fall dramatically. Both of those kind of tighter spreads and lower rates would boost total returns in the typical way through the duration exposure. This is a very nuanced argument. So we're actually quite constructive heading into 2025, but recognizing that it's really for yield-based demand.
Which really raises the specter of giving up liquidity for more yield, right? And this is the reason why private credit's been expanding so much, because if you want just the yield, you want the income, it doesn't matter how quickly you can trade it and at what price you're going to be trading it for. How much do you expect that to actually turbocharge an expansion that already has been dramatic?
Sure, and it's a great point. Even an extra 150 or 200 basis points for institutional and retail investors is meaningful when you kind of compound that over time. We think that private credit has a lot more room to run in terms of its expansion, both the addressable market of borrowers that are using it and the addressable market of investors that are participating in it. So I do think that in an environment like this where you are focused on yield, a very attractive opportunity. The other point is the advantage of building in diversification in portfolios with floating rate exposures. Just given the uncertainty around the path for rates from here, we actually like building in floating rate exposures, whether that's in liquid credit or in private credit. Most of that happens to be floating.
BlackRock put out a report, your team put out a report basically saying that you expect the private market sphere to increase to the share. It's about 30% of the overall share of credit in 2030 from about 20% currently. I'm just wondering how much this changes the dynamic in public credit markets. How much the yield level looks very different now than it has in the past, because in some ways the private credit sphere is underpinning it, and basically sometimes weaker credits even get funded privately and not in public markets. The public markets look actually like they're a lot more creditworthy than they have in the past. Is that the case?
Sure. So I would say we see three pillars. We see the banks, we see the public debt and equity markets, and we see private markets as providing a wide range of financing opportunities to a wide range of borrowers. We think on net that's a positive for financial stability. I think the key distinction that you're pointing to is that for a given borrower with a given credit quality, actually they may be better placed to get funding from the private markets because they're not contending with some of the technicals that exist in the public markets. Very nuanced discussion, but CLO rating constraints, distressed investors pushing for a restructuring. Those are things that a company really needs to be ready for in the public domain. If they're early in their growth stage, if they're anticipating that they're going to need more flexible funding, actually the private markets would be a better option for them. It doesn't mean that they're lower credit quality. It just means that they can benefit more from that financial flexibility, and they may not want the noise in some degrees that you might encounter in the public markets. I would say the punchline, though, is we see an opportunity for all three of these markets, bank lending, public debt markets, private debt markets, to coexist peacefully. And that's what we're seeing in the market.
You also note that private debt isn't just an American phenomenon. Where is it broadening out?
It's broadening in areas that are currently more reliant on the banking system. So Europe and Asia have a long way to go in kind of growing that private markets financing. Actually, this has been something that President Lagarde has been talking about, the establishment of a capital markets union, funding innovation in Europe, boosting lower productivity in Europe so that it can kind of close that gap with the U.S. I think that actually the private markets have been a really important tool in financing innovation in the U.S. market, and that's something that we expect to broaden outside of North America.
You also have an interesting point where you went through a bunch of companies talking about tariffs for next year, thinking about what happens next year in terms of policies. What is the main takeaway and base case of these companies?
The main takeaway is actually a theme that we've been highlighting, which is dispersion but not widespread market disruption. I would highlight two really interesting things. One, companies made it very clear that they've been preparing for this for years, whether that was because of the first Trump administration or the pandemic. They've been building in resilience in their supply chain, even if it costs more. The other thing, which I have to say wasn't obvious to me until we did this review, some of these companies actually expect to benefit from supply chain disruptions. Take off-price retail, for example. They actually said that a supply chain disruption could disrupt inventory patterns of traditional retailers, and they may take advantage. Just makes the point that this is not kind of a one-size-fits-all approach, that we really do have to do granular credit work on this.
Just quickly, the maturity wall.
Yes.
How many bricks did we take out in 2024? Are we in a better place?
Yeah, I think if we have spread widening next year, it's not going to be because of a payment shock or maturity wall. It's going to be because of some sort of macro event, tariffs. The corporate borrower sphere has been so incredibly proactive at managing that. It's been incredible.
We can survive through 2025?
Absolutely. Yes.
Okay, good to know. Amanda, thank you. It's good to see you. Thank you. Amanda Lynham there of BlackRock on the credit markets going into next year. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Another tech CEO has made the trip down to Mar-a-Lago to meet with President-elect Donald Trump. People familiar say that Chris Marszalek, CEO of crypto exchange Crypto.com, met with Trump on Monday. The two discussed appointments related to the crypto industry and a national Bitcoin reserve, the People said. He follows Coinbase CEO Brian Armstrong, who reportedly had a call with Trump last month. Booking Holdings says the impact of inflation is still dampening travel demand within the U.S. In an interview with Bloomberg, the Booking CFO said that customers are still booking U.S. vacations more last minute, especially compared to Europe travel. The CFO added that demand in the U.S. was overall lower than anywhere else that Booking operates. And turning to sports, the Minnesota Vikings won their 7th game in a row last night after defeating the Chicago Bears 30-12. Minnesota was led by wide receiver Justin Jefferson, who had 7 catches for 73 yards, including 1 touchdown. The Vikings clinched a playoff spot over the weekend and now find themselves tied with the Detroit Lions for first place in the NFC North with a 12-2 record. The Lions and Vikings will play in the final week of the regular season in what could be a decisive game. That's your brief, John.
Danny, thank you. Thanks for the update this morning. Appreciate it. Up next on the program, setting you up for the day ahead and counting you down to a Federal Reserve interest rate decision.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
The opening bell is about 36 minutes away. Equity futures on the S&P doing okay. We're negative across the board. On the S&P 500, we're down by about 0.4%, with some morning movers. Let's cross over to Manus Cranny. Hey, Manus.
Jonathan, keep an eye on NVIDIA. Will the bottom feeders come in and pick this stock? We're in a correction territory. Satya Nadella over at Microsoft, the killer line. I am not chip supply constrained. We assume that they're one of the biggest customers of NVIDIA. Power, yes, he's got a problem getting power, but this is in correction. Do you step in there? Broadcom, one man's misery is another man's bid. 38% in 2 days. This is their NVIDIA moment, according to some people out there in the market. May 2023. We give a little bit back at the moment on Broadcom, but it is up 38% in 2 days. I'll leave you with a flush on Tesla. You spent time with Dan Ives. I won't reiterate all of that. Autonomous is worth $1 trillion. The Trump White House access, power, access equals the next 4 years a total game changer. Hence the reason why every single tech CEO in the world is either having dinner or giving $1 million to inauguration. Jonathan.
Almost said it, Manus. £1 million. Feel the same way.
Oh my God.
Pounds aren't worth what they used to be worth.
Oh boy, we're in that kind of morning.
Brutal.
We are in that kind of morning.
We are together.
We are together.
We are together.
Talking about pounds and those good old days.
Pounds sterling.
Yeah, exactly.
Back in my day.
Yeah.
No, anyway. Counting down to the opening bell. Here's the trading diary for the week ahead. The Fed's final meeting of the year kicks off today. And tomorrow, the Fed rate decision drops at 2 p.m. Eastern Time, followed by a Chairman Powell news conference at 2:30. On Thursday, another round of jobless claims and rate decisions from the BOE and BOJ. Plus, we'll get some earnings too, so look out for that from FedEx and Nike. And on Friday, core PCE and UMich consumer sentiment. Lisa, we are almost there.
Yeah, and this to me is going to be a fascinating week where you either reconfirm this idea of sticky inflation, a Fed that's coming around to that, or potentially we have another dovish surprise, because that tends to be what happens when Fed Chair Powell takes the podium.
Whatever it is, resilient U.S. consumer continues to show up time and time again. Also, I think the Trump administration incoming would accept it in pounds. It would be $30 million more. I just did the conversion.
To what, sorry?
If you were going to do 100 million pounds for $100 million.
Okay, all right. Thank you for that. All right. Coming up tomorrow, Julian Emmanuel of Evercore ISI, Neil Dutta of Renmark, Victoria Fernandez of Crossmark, and Priya Misra of JP Morgan. Need to get to the weekend bad, don't we? Need to get to the holidays. Get to 2025. What are you talking about? I haven't been on vacation. 2 days back.
I know.
Let's wrap it up. Let's go.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you?
I had actually run tech banking and took Google public, so I had a little sneak preview.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
All right, stocks hitting a wall after a big day yesterday. 30 minutes until the official start of trading. I'm Katie Greifeld.
I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, fresh retail data suggests that consumers remain resilient as investors await the final Fed decision of the year. There's also a new AI darling taking the spotlight as NVIDIA falls into correction territory. We'll take stock of Broadcom's massive rally and deal makers optimistic about Trump's second term that will fan the flames of the M&A recovery. We'll speak to the top tech banker at Barclays later this hour. All that and more coming up. Let's take a look at where markets are trading, of course. Like I said, 30 minutes until we hear those opening bells. It is none too pretty. The S&P 500, after a rally yesterday, now down about 3 to 0.4%. It's big tech that is really interesting. We know that the NASDAQ 100 hit a record high yesterday. That was propelled by an 11% rise in Broadcom. Taking a bit of a breather this morning, the NASDAQ 100 down about 0.3%. And the 10-year Treasury yield. This is where all of the quiet action has been. We are back above 440. Not a big move this morning, but the 10-year yield creeping higher and higher, Sonali.
And as we've been talking about just yesterday, that 4.5% danger zone is on high alert. Katie, let's take a look at some of the stocks under the surface. NVIDIA, as you've been talking about it, extending declines. It hits correction territory. It's been down 10% since December 5th, down 1.2% nearly today pre-market. Pfizer, though, up 2.4% pre-market, higher after forecasting 2025 sales in line with expectation. Remember, it is dealing with activist investors' starboard value, and it is dramatic over there. We're looking at Tesla also up more than 2% pre-market, up after an upgrade from Mizuho that cited an improved outlook under the Trump administration. Surprise, surprise, Katie.
Yeah, and still Tesla shares up about 2%. That's the micro. Let's talk about some of the macro here. All eyes on that Fed meeting tomorrow. But this morning, we got some retail sales data coming in hot on the headline level. Of course, if you peel out certain sectors, a little bit softer, but still on the headline, 0.7% increase driven by cars. Where is Matt Miller?
Yeah, no kidding. He's probably out there buying some of his own, I suppose. Do hogs count as cars? You know, it's interesting. Out of the sectors here, 7 of the 13 that you've seen categories posted increases. But if you stripped out autos, you did have retail sales a little lower than expected. So under the hood, a little bit of a muddy picture. Remember, the auto sector was something that was of grave concern just about a year ago. And you did see that cooling of interest rates, which did prop up that loan market for cars once again. Now, if you're buying all of this on credit, is it a good thing? Something to talk about.
Yeah, absolutely. And of course, BMO out with a note after the data saying this doesn't really change anything for tomorrow's Fed decision, but we know that consumers, we know that investors, and we know that policymakers concerned about sticky inflation. So let's keep this conversation going now with Alpha Simplex Chief Research Strategist Catherine Kaminsky. And Katie, it's great to have you back with us. I'm taking a look at your note, and you talk about this short-term focus on the potential for Fed cuts and, of course, continued economic data into year-end. The Fed's 2-day meeting kicks off today. What do you think the hottest topic of discussion will be?
Well, I think the general consensus is that we're going to see cuts, but I think the market is much more focused on what's next, and that's why you see that today. So you see, for example, yields repricing, perhaps a less aggressive to cut Fed into next year. You also see that equities are perhaps seeing a little bit of a tailwind on that. And I think the biggest fun one to talk about this week is going to be the US dollar, which has been the biggest winner this month. So I think what we'll be talking about is how do you weigh the inflation data versus strong growth going forward?
Well, let's talk about equities, you know, from that bevy of asset classes. Equities are in an interesting spot right now because, of course, you have the equal weight rotation trade kind of sputtering out. Big tech is back in charge, and that's not what's supposed to happen. Seasonally speaking, I mean, December is a really good month for those small cap stocks. What do you make of the current trade and whether or not that will sustain into 2025?
That's a good point, because what we really have seen is a very narrow rally for the U.S. The U.S. has come out ahead this month, but it's really on the back of tech, like you pointed out. And so I think one of the reasons this may be the case is just if you look at how much small cap rallied last month, there was really a lot of really big moves. So I think the question would be, if you don't see that type of pattern this month, is it a question that this pro-growth, pro-U.S. narrative maybe isn't as strong as some people think? And I think that's something people will have to weigh as they're trying to digest the change in administration in the U.S. and how pro-business and pro-growth the new policies may be for small cap.
It's interesting because if you think about the growth picture here, you look at the data just this morning, you're seeing yields back on the rise a little bit, not as much as we saw just last week. You have T. Rowe, the Chief Investment Officer of Fixed Income, writing that the 10-year may climb to 6% for the first time in more than 2 decades next year. What's your call on this, Katie? And what would that even mean if we reach levels that high?
Wow, I think definitely that's exciting for someone who likes to short fixed, who has been a follow short signals in fixed income. But I think right now our technical signals aren't showing that yet. We're seeing short signals in fixed income for the U.S. that suggest perhaps more of a slowdown. I think what their estimate is really pointing at is if inflation were to tick up, that could happen, but I think a lot of things would have to accelerate to see that type of move in fixed income. There'd just be a lot of buying pressure, so we'd have to have very strong inflation and strong growth to kind of get to a point where the bond market would want to price in long-term inflation and get us to 6.
It's interesting because, you are just under that 4.5% level, and we spoke yesterday to Max Kettner at HSBC, who called that a danger zone. If you start to see yields drift higher, maybe not 6%, but still higher, then what does that mean for equity investors ultimately and anyone who's taking on some risk right now?
Well, I think higher yields, it's tricky because as yields are higher, it has definitely a dampening effect on real estate. It has a dampening effect on borrowing for small companies. So I think there's just always that headwind of higher interest rates become a little bit of a slowdown for the economy. And we haven't seen that yet in GDP numbers, but I can see why a lot of times that sort of trigger point of having those rates going to a critical level could suggest that it might put pressure on companies and on individuals, slowing the economy down, which I think is the general concern.
Well, part of the conversation we were having with Max Kettner yesterday was not so much about the level, but he was also talking about the pace of the increase and the potential for disorder if we see a rapid rise. I mean, when you're evaluating the bond market, the relationship, the dynamic with other assets, particularly with equities, I mean, which should we be focusing on when it comes to tails and dogs?
This is a good question because honestly, the thing that I have really been surprised by this month, and this is something to point out, is that stock bond correlation has moved positive this month on the shorter time horizon, which generally happens when the market is more concerned about inflation instead of growth. And so I think if we start to see some acceleration in inflation data, I would actually look at the bond market because I think the bond market is where people tend to go to determine sort of what is the focus. And I think right now the bond market is really trading on, could inflation be higher? Could the Fed pause? And that's why I think right now those correlations are really something to watch and see if they accelerate.
What does this all mean in terms of where you find either a hedging strategy or diversification? Because if you're looking at the correlation turning positive once again, it breaks down that 60-40 once more. And we've seen that happen over the years pretty significantly enough to worry. Commodities have been volatile. Do you look to gold? How do you find somewhere else to go?
This is a really good point, because what we see when stocks and bonds are positively correlated, inflation drives the markets. You tend to see less hedging properties in fixed income, and fixed income tends to be more volatile, both things of which make our portfolios less diversified. So I think for investors, it's really about looking at other assets like commodities, which haven't really been easy this year, but might be under a case of more inflation, as well as looking at long short strategies and different approaches to diversify that classic stock bond exposure when the correlations deteriorate, become positive, and volatility in bonds is higher.
Katie, we thank you so much for joining us this morning. Of course, that is Alpha Simplex, Katie Kaminsky, helping us navigate these very choppy markets. We're going to look at some stocks moving ahead of the opening bell. We're going to bring in Abigail Doolittle.
Starting off with the shares of Affirm, which are down in the direction of the major indexes, also down about 3%. The digital payments company, they have brought out a private offering of $750 million in convertible senior notes. This is possible dilution in the future. Plus, the stock up 48% on the year. There's a 7% short interest, so it appears some investors taking chips off the table. Turning to one stock that is soaring, Solar Edge. However, on the year, down about 87% into today, and there's a 35% bearish short interest. We have a double upgrade from Goldman Sachs to buy. The firm is saying that the market is overplaying the risks around green energy with the new administration coming into office next month, and that Solar Edge is a buy. They create technology for solar panels. And then finally, Tesla. This is really pretty incredible. This stock now, Katie, up 80%, more than 80% on the year. You can remember earlier this year, it was a stock nobody wanted to take a look at. Today, we have an upgrade at Mizuho, another double one from outperform from buy, or excuse me, from neutral, an improving outlook under the Trump administration that will be taking, again, office next month. Essentially, the idea that there could be relaxed regulatory structure for those robo-taxis, the repeal of the tax credit for the other automakers, and you can see shares responding up 2.3%.
Absolutely, and incoming White House trade counselor Navarro was speaking on CNBC this morning saying that the Biden EV mandate will be gone under Trump. Investors taking that as good news for Tesla, or at least not bad news. As Abby said, of course, Tesla shares. But let's take a look at the broader market right now, because it's not too pretty of a picture. You have the S&P 500 down about 0.4%. I'm really interested by big tech right now. We know that the NASDAQ 100 has been on fire. It hit a record high yesterday. Broadcom, you can thank for that, even though NVIDIA has been a bit underwater, and that's exactly what we'll be talking about next. Broadcom shares have jumped nearly 40% in recent days as traders see an NVIDIA moment for the chipmaker. We'll have all the details after the break. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but you can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, anywhere.
Go.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Wednesday, the Fed decides.
The consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause.
Yeah, but it's pretty high bar.
All of this seems very predictable.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
People feel good about where the economy is. Demand is obviously pretty strong. If there were black clouds on the horizon, what would they be?
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
And now to high interest, a look at what's making headlines around the world. Ukraine is claiming responsibility for the assassination of the head of Russia's nuclear defense force in a bomb explosion early today. The Russian general and his assistant died when an explosive device planted on a scooter detonated in Moscow. The killing of such a high-ranking officer in the Russian capital adds to spiraling tensions over the war as President-elect Trump returns to the White House next month. Yesterday, Trump told reporters that Ukraine should be ready to reach a deal to end the war. And the Federal Trade Commission is finalizing a rule that would ban so-called junk fees for live events, hotels, and vacation rentals. The rule would require businesses to disclose total prices up front rather than tacking on extra costs like resort or convenience fees when consumers check out online. The rule would not stop businesses from charging fees, but they would be required to list prices clearly from the onset. And TikTok CEO met with President-elect Trump at Mar-a-Lago yesterday. This is just weeks before the popular video app is expected to be banned in the United States over national security concerns. Trump had previously tried to ban TikTok during his first term as president, but has since switched his stance on the app. Before the meeting yesterday, Trump suggested that he might try to reverse the ban to save TikTok, which he used to reach young voters on the campaign trail, Katie.
All right, so we'll keep an eye on that one and those 6-second videos. But let's talk about Broadcom, because shares are higher by nearly 38% over the past 2 days since it reported those strong earnings driven by AI optimism. Let's take a look at the share price compared to NVIDIA, because the chipmaker is showing investors that AI demand is so strong that there's plenty of room for leaders at the table. Bloomberg's Ryan Vlastelica reported on this, joins us now. And Ryan, compare what we heard from Broadcom last week in their latest earnings report to what we saw from NVIDIA in May 2023.
Hi, good morning. Thanks for having me. So yeah, we did talk to a lot of people for the story who basically said, is Broadcom kind of at that NVIDIA moment where people started to grasp the full scale of the AI tailwind, the kind of growth driver it would really represent for the company's products. And that's why we saw this just enormous rally in the stock last week. And people do see a lot of parallels between where it is now in the AI cycle and where NVIDIA was about a year and a half ago.
Well, draw out those parallels. You take a look at the stock chart right now and you see the catch-up trade, the 123, almost 124%. Broadcom has risen year to date, not quite NVIDIA levels, but getting closer. And if there are parallels, what does this mean for Broadcom's gains to come? Is it a sure shot upward, or are there serious risks to that story?
Yeah, that's a great question. I mean, obviously no one quite knows what's going to happen right yet, but the comments that Broadcom gave in its report, in its earnings call, where it talked about the growth kind of potential it sees from AI products, indicates that this is going to be a pretty long-term tailwind. And now, the way the AI spending has been working, as people build out their infrastructure, first you buy the NVIDIA chips to build out your data centers. Now people are buying Broadcom components to connect all those data centers. So this is sort of the next leg of AI spending, and the company is pretty optimistic about its growth potential from here. Now, we have seen a few other companies that have pretty pronounced AI tailwinds. Those stocks haven't done quite as well. Sometimes it's a valuation issue. Sometimes it's a execution issue, so we don't know which side Broadcom is going to go on yet. Obviously, NVIDIA is coming off an extremely strong year. Last year was extremely strong. But Broadcom, I think, is on track for its best, at least percentage gain in its history since it went public in 2009. So certainly a very strong year for them. Not quite NVIDIA levels yet, but so far no one has really been able to touch them.
Well, you mentioned valuation, so let's talk about it a little bit more, because you take a look at Broadcom currently trading 38 times 12-month forward earnings. Pretty eye-popping figures there. And NVIDIA, at the same time, has been getting cheaper, at least by that measure. How are the investors and analysts that you're talking to thinking about the expensiveness of these stocks?
Yeah, so one thing that was interesting about NVIDIA is that it was growing so quickly and estimates were rising so rapidly that the stock was actually getting cheaper even though it kept rising. We're not quite seeing that with Broadcom. People are pushing up their estimates, just not to the degree that the stock is moving up. So the stock is getting a little bit more expensive. That does mean that it's going to be a little bit of a higher bar. And to name another AI stock, we can look at ARM Holdings, which in February gave this very strong forecast. The stock was up, I think, about 50% in the immediate aftermath of that. It's sort of treaded water a little bit since then, just because that multiple is closer to 80 times forward earnings, so a much harder bar to clear, just harder to justify that kind of multiple. So that's kind of the two, maybe paths you could look at these stocks taking. Is Broadcom going to be growing rapidly enough that it's able to justify where the stock has already moved? That would be sort of the NVIDIA path. Or is it one where maybe it's just not able to meet these high expectations, and then the stock has to consolidate or pull back or just sort of tread water for a while, which is more of what we've seen with ARM, at least this year.
I'm glad you brought up ARM, because that's where I was going to go, just companies outside of Broadcom, because of the more than $410 billion in market cap that was lost by NVIDIA since its high. It's interesting, DataTrack points out that more than $300 billion of that market cap was kind of made up here by the gains you saw in Broadcom. You had another nearly $30 billion in market cap added at Marvel. Are investors just looking for trades outside of NVIDIA right now to capitalize on, given the run-up we've seen? And who are the biggest beneficiaries?
Yeah, it wouldn't surprise me if the idea was, everyone knows about NVIDIA, everyone is aware of these tailwinds. What is going to be the next kind of company to benefit? One that's maybe trading at a lower multiple or just earlier in the cycle. Even outside of the chip space, you've seen just enormous gains in a stock like Palantir this year, because that is a very AI-focused software stock. So you are seeing people looking elsewhere, but obviously AI remains sort of the central theme for tech investors, if nothing else.
Ryan, we thank you so much for joining us this morning. That is Bloomberg's Ryan Vlastelica. We thank you for your reporting. And coming up later this hour, we're going to talk tech opportunities with Kristen Roth de Clark. She is the global head of technology investment banking at Barclays. And in the next hour, we're going to talk about the real estate angle of AI and data centers and more with Blackstone's Nadeem Megji, who has made this a key focus for him and his team. That's all ahead on Open Interest. Stick with us. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe. We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
Today, Bank of America CEO Brian Moynihan sits down for an interview with Bloomberg's David Weston to discuss the Fed decision today at 3 p.m. Eastern, only on Bloomberg.
All right, minutes away from the opening bell. This is your setup heading into the Tuesday cash trade. You can see we're on a down note for the S&P 500, for the NASDAQ 100, for your small caps as well. Big tech has been doing all the heavy lifting in this market, but that momentum breaking a bit today. You can see the NASDAQ 100 down about 0.3%. Actually resilient when you take a look at the other big benchmarks. The S&P 500 down about 0.4%. We're still above 6,000, so that's the good news. The Russell 2000 really struggling with this rise in rates that we've been seeing. Of course, currently down about 0.4%. We know that the Fed's two-day meeting kicks off. We know that the fiscal has been the topic of conversation in these markets, but at least for right now, at least for a day, as Abigail Doolittle said in her morning note, of course, Jerome Powell is going to take over, and we'll see if he can put some life back into these markets, Shanali, because it's certainly been an uneventful start, of course, to the final full trading week of the year.
Yeah, certainly uneventful, but very interesting as well, because you do see single stock movers that have been moving the market to the point you've been making yesterday, that you did see, yes, NVIDIA still entering correction territory, but Broadcom having made up for some of those gains. Maybe not as much today, though. You are seeing all the indexes lower, but you are seeing some life here in other stocks. Pfizer up on the heels of lifting its guidance. You have Burla also talking about his meeting with Donald Trump in Mar-a-Lago, him and many other CEOs, and Tesla also higher as well, expected to gain from that Trump trade. But coming up, Katie, we're less than 4 minutes to the opening bell. We're going to discuss the market moves with Stephanie Guild of Robinhood. We're going to talk about what's moving under the hood. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
All right, we are moments away from the start of trading on this Tuesday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You take a look at the averages right now in the pre-market, just seconds to go, giving up some of the gains that we put in place yesterday across all the benchmarks right now. But nevertheless, the bells are ringing with people clapping over at the New York Stock Exchange, down at the NASDAQ as well, of course. There's plenty to look forward to this week. The final full trading week of the year. We've got the Fed, we've got earnings, we've got economic data, retail sales coming in hot this morning. But you take a look at how it's translating all together into the major benchmarks right now. None too pretty. The S&P 500, of course, it was higher by about 0.4% yesterday. You can see that it's now down 0.4% just in the first 22 seconds of trading. The NASDAQ 100, a big day yesterday that was led by Broadcom's 11% advance. Taking a bit of a breather right now. The Russell 2000, the little guys are your biggest loser at the moment, with the small cap index down about 0.6%. That is the picture at the benchmark level. Let's take a look under the hood, because we have to talk about NVIDIA. Testing levels not seen since August as it drops near $130 per share. The stock has fallen 5% in recent days and officially fell into correction territory on Monday. This, of course, is the flip side of that Broadcom story that we've been talking about this morning, Sonali.
Yeah, super fascinating to see the year's most beloved stock finally getting a breather, but love maybe elsewhere, including in Tesla. You're watching Tesla shares climb on a Mizuho upgrade. Analysts are bullish on autonomous regulatory frameworks under the incoming Trump administration, and Mizuho's price target is now $515. We're at $471 right now. Finally, Pfizer is higher after forecasting 2025 sales in line with expectations as it deals with activist investor Starboard Value. That is a drama we can't keep our eyes off of. We're going to get a closer look at Pfizer now with Bloomberg's Abigail Doolittle.
Yeah, and this gain, Sonali, comes within a decline since the election, down about 7%. Some concerns perhaps around their vaccine practice. But interestingly, CEO Albert Bourla did just recently say within this update that after his dinner with President-elect Trump, that the attitude may not be as negative toward vaccines as expected. And he also said that Trump is very committed to PBM reform on this, the shares of CVS dropping. Now, you can see that spike higher. And if we take a look at the earnings for the year, essentially the street very positive about this. We're looking at $2.90 for this year and then $3 for next year. The street is saying that the midpoint is above where the street had expected. BMO BMO saying that it's reasonable yet achievable. Citi saying the guidance is in line with the sell side, but not the buy side. That's a positive, clearly, since the buy side might be encouraged to buy, and that there could even be more upside. On the year, let's put it all into perspective, because we have the shares of Pfizer down on the year. You can see in orange Pfizer, and then Johnson & Johnson, Bristol Myers Squibb, and AbbVie. So Pfizer does have its work cut out for it in 2025 to catch up with some of its pharmaceutical peers, Katie.
Yeah, absolutely. Some good news for Pfizer today, but that's certainly a deep hole to climb out of. Our thanks to Abigail Doolittle. Let's broaden out this conversation now, because sitting to my left, we have Robinhood's head of investment strategy, Stephanie Guild. She joins us now. Great to see you in person.
Likewise.
So let's talk about this rotation trade and maybe saying it goodbye, because it's been interesting to watch the Magnificent Seven lead the S&P 500 equal weight by the most on a monthly basis since May 2023. And we were talking in the commercial break how it's a bit curious to see big tech take back over. What do you make of this dynamic and whether or not you think it'll last?
I think a couple things. When I first started rallying, post-election, we had the small cap rally, we had Bitcoin rally, we had a lot of things rally in favor of the election, and I thought that was going to kind of continue. It was the start of this broadening. I still think that is possible, but we did have the 10-year kind of come off the boil and drop quite a bit, and so I thought, oh, that's sort of why these growth stocks are rallying. They're longer duration stocks. But now that we have, the 10-year kind of coming up, I'm starting to wonder. And I'm not sure why, because there's really no data that supports this yet. Are the markets starting to be worried about growth? And are they just looking for places for maybe more sure growth that if they think the economy is not going to be there for it?
It's interesting. I mean, Neil Dutta had a note out this morning talking about how he's on the cautious side of the growth outlook. And even still, I mean, you're seeing this rise in the long end of the Treasury curve. You think that if you were worried about that investors would be buying bonds. But is it possible that it's the big tech names that have turned into sort of the haven trade here?
Yeah, I think it's absolutely possible. And I think the 10-year has another factor that it maybe hasn't had in a long time in history, or possibly ever, and it is our deficit. They are debating pushing the debt ceiling out. It's going to expire December 20th. And it maybe starts to show that things aren't going to be as easy as perhaps the euphoria might have expected post-election.
Speaking of euphoria, I am very excited to see what Robinhood's own customers, the retail crowd, is doing about some of the moves that you're seeing of late in markets. How are they trading December? Are they buying into that MicroStrategy story with the NASDAQ 100? Are they selling NVIDIA with the wave?
You did see, so during the month of November, you saw them take some profits in the names that had done them the best. Tesla, for example, and then putting that money into, on the margin, places like NVIDIA and Amazon. Since that time, you have started to see them take some profits there. MicroStrategy has been the place that has defied the typical behavior of our customer, which is to trade around the shifts in their core positions, and haven't really seen them, despite the rally in the name, take many profits. I'd just say in the last more recent time period, I've started to see a little bit of it.
Is that because they're already overexposed, you think? Or is that because they're saying, hey, why would we buy MicroStrategy when we can just buy Bitcoin?
I think they're doing both. It's what we're seeing from our activity. And I think our customers, they do tend to take a long-term view in core positions, and you've seen that in the electric vehicle space and in Tesla for sure. But you've also seen, Bitcoin is another place, I would say, that it's sort of like if you're in the camp that you believe Bitcoin has a long-lasting place in the markets, then you stick to it. And I think there is a paradigm shift post-election. I think that more and more of the institutional players are going to start using it as another tool in their toolbox in terms of asset allocation.
Yeah, and it's interesting. You had Trump's embrace of crypto seemingly on the campaign trail, but certainly some of his picks to top government positions have been backing that up. I actually want to go back to the deficit and the Robinhood crowd. I mean, what we're talking about, these concerns that maybe we're starting to see in the bond market about the deficit, you could make the case that you're seeing some of that in certain places of the stock market. Is any of that reflected in your Robinhood customer activity, or does that not exactly make it onto the radar?
I don't think it makes it onto the radar because we haven't seen much of a shift in the types of companies that they invest in and trade in. But I'm not sure that there's that much of a connection between the types of things that they invest and trade in and the deficit, because they are investing overall in growthier companies. And if they tend to grow, like that typically can happen despite what's happening in the government.
I want to go back to what you were saying earlier about these growth concerns as well, because you saw retail sales this morning. Presumably the Robinhood customer is the same one that's going out and spending in a store or buying a car, right? And so if you're seeing kind of strong retail sales, but it was choppy, but you're seeing an animal spirit plateauing in the market, what does this mean on aggregate? Do you think they head into 2024 with, guns blazing here and ready to put more money in? Or do they say, okay, well, wait a minute, we're a little maxed out and it's time to take note of those worries?
I think overall it's healthy to take note of those worries, and I do think you're seeing that here. I strongly believe that expectations are everything when it comes to the market. And there was a lot of expectations that have been built into the market, especially post-election. And it makes sense to kind of see a little bit of like a tempering. And in particular, there may be an aspect to this market where people are going to wait to take some gains. I wouldn't be that surprised if we have a little bit of a correction sometime early next year. But I don't think it necessarily means that it's the beginning of a new trend where there's softness in the economy and the market. I truly believe, and I put out my outlook last week, that we're going to continue with this soft landing, like positive growth story. But there is more uncertainty now, because I think initially post-election, there's a honeymoon about all the positives that come from a new administration, but there also are some uncertainties when it comes to things like taxes and tariffs and even immigration that can affect the economy. And I think that's starting to be realized now.
Well, that's where I'd love to end with you, and we only have just a minute left, but you think about expectations for 2025 and this tug of war between monetary and the fiscal. Who's in the driver's seat?
I think for me, it's more fiscal than monetary, because, I think next year is going to mostly be a market where the Fed cuts a couple of times, and then, it doesn't create the waves that it has over the last couple of years. I definitely think it's going to be more of a deficit issue.
Stephanie, thanks for coming in this morning. We really appreciate your time. That is Robinhood, Stephanie Guild. And coming up, swiping right is so last year. Users are in love with prompt dating, and it's messing with Wall Street's Tinder romance. We're going to give you details and top calls next. This is Bloomberg.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice, because the US and China have already started the race, and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, welcome back to Bloomberg Open Interest. You're taking a look at the stock market right now, about 13 minutes into the trading action. You can see the S&P 500 down about 0.4%. We were higher by 0.4% yesterday, so it's early, but we're flat on this week. The NASDAQ 100, though, after a big day yesterday, 1.5% higher, taking back some of that right now, down about 0.4%. The Russell 2000 is your biggest loser at this moment, down about 0.5%. It's time now for our top calls, though. Some of the analyst action in focus this morning, and we start with Brown-Forman getting downgraded to sell at JP Morgan. The analyst says that tariff risks could be a double whammy for the spirits maker, currently down about 0.9%. Next up, we have Mizuho upgrading Tesla to a buy, citing an improved outlook under the new administration. Big surprise there. The analyst says that Trump's policies, namely the repeal of a consumer EV tax credit, gives Tesla an advantage over its peers because of its lower EV cost structure. Shares up another 2.3%. And finally, Jefferies saying that Match no longer a buy. The firm is downgrading the online dating app to a hold after the company's Investor Day event, where it warned about revenue trends for its Tinder app. Match Group says that there has been a consumer shift away from swipes to prompt dating, where users engage with prompts or questions to spark conversations. You learn something new every day. Match shares down about 1.6%. Now, coming up, deal makers expect a second Trump presidency to boost deal activity. We'll talk M&A with Kristen Roth DeClark, Barclays Global Head of Technology Investment Banking, next in our Wall Street Beat. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
And it's time now for the Wall Street Beat. Deal making bounced back this year. Global transactions have hit $3.1 trillion. Now, bankers are optimistic that Trump's second term will turbocharge the recovery in M&A. Joining us now is Kristen Roth de Clark, Global Head of Technology Investment Banking at Barclays. And, you know, one question I have is you've seen CEO after CEO go to Mar-a-Lago over the past week, many more coming. And does that mean that it's a sure shot that those big tech companies won't be clamped down upon next year?
I think that investors are broadly expecting a less restrictive regulatory environment under the new administration, and for that reason expecting a tremendous surge in M&A activity going into 2025.
So what is happening under the surface for your industry? You have all of these tech companies. The IPO window is just starting to reopen. A lot of success there, but you haven't seen those big tech players really come to the fore for many months. Do they go public or do they sell?
I think there's more conversations around going public. I actually think 2025 will be a busy IPO year. One, because the performance of the IPOs that in 2024, while there were only 8 tech IPOs, they're trading up over 100% on average. And companies are now looking at going public for the reason of having acquisition currency. It's less about providing liquidity for employees because the secondary market continues to be very strong. But they're, especially with increasing M&A activity and potentially a less restrictive regulatory environment, more ambition to get public to have that currency.
That's really interesting. Let's fold valuations into that, because if you do see this wave of tech IPOs come to the market in 2025, I mean, how would you expect them to be valued, especially to some of their more recent private funding rounds?
Yeah, so 2020 and 2021 were a kind of a moment in time as it relates to valuation paradigm. We're in a new valuation paradigm today, and I think investors expect that, companies understand that. Over a third of the tech IPOs this year went public at valuations that were lower than their last private round and have transcended that now in the public markets. And so there really is no stigma associated with going public at a lower valuation than your last private round.
That's interesting. Is that a change, the fact that there isn't that stigma, or have people accepted that maybe we were in silly season in like 2021?
Yeah, I think it's really just things were so unique that time in 2020, 2021 relative to history as it relates to valuation, that it's just an expectation today that we have a new framework.
So what does this mean in terms of the types of companies going public? Because of course the topic of the day has been AI, but if you don't have that kind of AI tag to you, can you make it public as easily, realistically? Do you think that that is a necessity almost if you're a technology company today?
I think every company has to articulate their AI strategy in some way, but it can show up in different ways. In some ways, in some enterprise businesses, it's showing up more in margin improvement because they're using AI to improve efficiencies. In some consumer-facing tech businesses, it's showing up more in the user experience and adoption of that platform or technology.
So let's also talk about M&A. In addition to the IPO market, obviously the two are related, but you are starting to see M&A come back. You have all this optimism, as Shonali walked us through. I'm wondering about deal sizes, though, because it seems like we haven't seen a lot of really big mega deals, double-digit billions. What's your expectation when it comes to actual sizing?
It's pretty awesome because we're starting to have these conversations with companies about these mega M&A deals. And I think post-election, that level of kind of moving from conversation to potentially action has increased pretty significantly. So I do expect we'll see 30, 40, potentially $50 billion type deals at least announced at some point during 2025, just given the level of conversation with some of our clients.
One question I have is, these are large deals, as you've been talking about, but why not wait a minute? I mean, valuations are near all-time highs. The NASDAQ 100 has been on a tear. And you're talking about a dynamic that could create a lot of competition. If people are trying to go public, then wouldn't that make the premiums much higher if you're trying to buy?
Look, I think that both M&A and the equity market kind of work in concert in some ways. If there is a bid, if there's a bid for essentially companies that are public to do take privates, if there are subsidiary IPOs or carve-outs of existing public companies going to M&A, going to other buyers, both of those kind of feed on each other. And so I expect that along with the more healthy M&A environment will also bring along a more healthy IPO market.
What is that like for the private equity firms as well? Because if you're now, third element of competition, right? They have tons of dry powder on the side. Financing markets have been open. Leverage loans have been booming once again. Are they ready also to play in these maybe competitive situations?
Yeah, and I think we'll see, well, first of all, we'll see, I think, increased activity around take privates because the financing environment is such that it makes it more attractive. The second piece is we'll see more private equity firms taking companies public to try to return capital to LPs, and there just haven't been as many sponsor-backed IPOs over the last couple of years or the same cadence of returning capital to LPs as we've seen in previous years. So I do think there's more pressure to get some of those assets off of their books.
And I do want to zoom out because one of the big stories on the terminal this morning is that deal makers awaiting Trump after bouncing back with $3 trillion haul. We've been talking about, you know, this optimism, there's this enthusiasm, and it does seem like things are unlocking both in the IPO market and in the M&A market. Do you worry, though, that we're getting a little ahead of ourselves, that we're getting a little over our skis, and that the potential for disappointment is pretty high right now?
I think a lot of it remains to be seen post January 20th and some of in the way that the priorities of the next administration are messaged. But there is a lot of optimism today. So if it doesn't follow that, of course, you could see at least a short-term correction. But I think longer-term investors have confidence that there will be a less restrictive regulatory environment, which should increase deal-making activity.
Yeah, you think about the wave of risks out there. What's the one thing you think that could stop the party?
Well, I think some of the geopolitical threats that we aren't aware of, right? I mean, we're in a very different place today than we were a year ago. We came into 2024 expecting 7 to 8 rate cuts in 2024 expecting 7 to 8 rate cuts. We came in with a looming election. We now have the election behind us. We have more modest expectations around interest rate cuts going into 2025, markets pricing in 2 or 3. But there are always geopolitical uncertainties that are hard to forecast.
All right, Kristen, it is great to get some time with you. Hope to see you again in 2025. That is Kristen Roth de Clark of Barclays. Meanwhile, let's get a check on these stocks right now. We are about 25 minutes into the U.S. trading day. You can see we're on a down note right now across all index levels. The S&P 500, the NASDAQ 100, the small caps, all in the red today after a pretty good day yesterday. What's interesting to me, though, is that if you take a look at volume right now, Sonali, we're actually above our 20-day average on the S&P 500, about 21% higher on trading volume right now. And I guess it makes sense. It's December 17th.
Profit taking.
Well, profit taking, and also if you have a trade to make, if you have windows to dress ahead of year end, this is probably the week to do it.
Those window dressing trades might be the most popular ones out there at this moment. But of course, the big day is still tomorrow. Excited to see if that shakes things up a little bit.
Exactly. Not so much on the decision tomorrow. We know they're going to cut rates, but what are they going to do in 2025? What will the dots say? Maybe Linda Dissel will have some answers for us. She'll be joining us at the top of the hour. She says that there's evidence of fatigue in markets right now. And then we're joined by Blackstone's co-head of real estate joining us. Really looking forward to that conversation. Of course, that big call out of T. Rowe that, maybe we'll see 6% 10-year Treasury yields. That would certainly have implications for real estate. And then we'll be joined by the CEO of Cisco. We're going to be talking about food inflation. We'll be talking about tariffs. All that and more coming up. Don't go anywhere. This is Bloomberg.
Fofana. I am the owner of the AF Family Office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so anybody, we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week, from morning to night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. We begin at the White House, where President Biden is praising a decision by the Federal Trade Commission this morning to ban hidden junk fees.
The rule requires ticket sellers, hotels, and vacation rental sites to disclose all of their fees up front, something the president has long supported. In a statement, he said his administration has done everything it can to lower costs for hardworking Americans. He added today's announcement builds on that promise and will save many families hundreds of dollars each year. The statement goes on to say, quote, "These junk fees sneak onto your bill and companies end up making you pay more because they can. These fees add up, taking real money out of the pockets of Americans." Linda Kenyon, CBS News, the White House.
Just in from New York, Rex Heuermann, the Long Island architect facing murder charges in the Gilgo Beach killings, has now been charged in the death of a 7th woman. Officials say the 24-year-old had been working as an escort in Philadelphia. Her remains were found on Long Island 14 years ago. As they try to pin down a motive, police in Madison, Wisconsin say they're putting together a timeline of a 15-year-old's last hours before she shot and killed a classmate and a substitute teacher before turning the gun on herself. Police Chief Sean Barnes tells CBS Mornings,
"We'll spend a lot of time today going through some items that we took from her house as a result of a search."
He says they're trying to determine where she got the gun. Ukraine is taking responsibility for the assassination of a top Russian military chief. CBS's Haley Ott.
Lieutenant General Igor Kirillov was the head of Russia's nuclear and chemical defense forces. And investigators say he and his assistant were killed near the entrance of an apartment building in Moscow this morning by a bomb, which was hidden in an electric scooter.
A grandmother from Gadsden, Alabama, has new hope for life without dialysis after undergoing kidney surgery here in New York. CBS's Jim Krasula has the story.
She calls it a new beginning. 53-year-old Tawana Looney is the fifth American given a gene-edited pig organ as doctors work to make animal-to-human transplants a reality. The others all died within 2 months, but Looney wasn't as sick as them. The latest transplant surgery took place November 25th at NYU Langone Health.
It'll be music to the ears of a popular kids' cartoon series fans. The BBC and Walt Disney have just announced they'll collaborate on a movie about Bluey, the blue heeler pup. It'll be made by the same Australian studio that produces the TV show. Team hopes to release it in theaters in 2027. This is CBS News.
Available in all states.
The king's kid brother will get a big lump of coal in his Christmas stocking.
Palisades have let it be known that Prince Andrew will not attend the royal family's traditional Christmas gathering, which always sees the royals walking to church, greeting onlookers, and being photographed by the world's media. This after revelations that Andrew had been befriended by a wealthy Chinese businessman whom UK security officials suspect is a spy. Yang Tangbo has now been banned from re-entering the UK. Andrews insisted he ended the association as soon as he was told of Yang's possible links to espionage. Vicky Barker, CBS News, London.
New report says some Walmart employees have begun wearing body cameras as part of a pilot program aimed at tightening security and cutting down on theft. Spokesperson tells CNBC it's being test piloted in one market, and if it works well there, they'll expand. The network says associates at a store in Denton, Texas have already been spotted wearing the yellow and black body cameras. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney, we are live here. We are also streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Coming up here today, we'll get the latest on the markets with our friend Alex Semenova from Bloomberg News. Michelle Davis, Bloomberg Senior Deals Reporter, talking about the M&A market starting to really bounce back post-election. Anticipation that President-elect Trump's administration will be more bullish for M&A. James Abate, he's a managing director and chief investment officer at Center Asset Management, will give us his thoughts on these markets. Sam Fazeli, Bloomberg Intelligence, he's a director of research over there in London. He's also probably one of the better pharmaceutical analysts out there on Global Wall Street. Talked to us about Pfizer's results. Kind of stable, which is, I think, for Pfizer, that's all investors were kind of looking for, is to get some stability post-COVID in some of their numbers. We'll break that down. Right now, it's good. Alicia Mateo.
Whoa, hold on.
What? Go for it.
Bitcoin. $108,000 for the first time. Bearing that lead, Paul.
Somehow, Tom Keene and I did not cover that in the 3 hours of surveillance. We managed to miss that, but $108,000. Thank you for pointing that out.
You're welcome.
That's what the kids are focusing on. It's been a huge run. So,
let's go to Business Flash now.
with
Let's
Lisa
do Business
Mateo.
Flash, 'cause I'm dying on my peanuts.
Now he's choking from goldfish. All right, Lisa, let's give us a business flash here.
Gotta love those goldfish. All right, this Bloomberg Business Flash brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast. Get started today. Well, we've got red on the screen. This is after U.S. retail sales topped forecasts in November. Autos led the gain, sending total retail sales up 0.7% last month. Online sales also advanced during Black Friday and Cyber Monday promotions. In all, 7 of the retail reports, 13 categories increased. Another data point, a report on industrial production that fell for a third month in November. Factory output barely budged last month. Outputs at mines, utilities dropped. Hurricanes, as well as extended that Boeing aircraft strike that also took a toll. Now, this all comes, yes, ahead of the Fed's decision on interest rates tomorrow. We get to the NASDAQ down 0.4%, 99 points at 20,073. The Dow down 0.5%, 250 points at 43,466. The S&P 500 down 0.4%, 28 points at 6,045. We had the 2-year yield, 4.24%. That's little change. The yield on the 10-year, 4.39%, and that's little change. The Bloomberg Dollar Spot Index is little change. The crypto party continues. Alex said it. Above 107,000 right now. Crypto link stocks. So we're checking with Coinbase, down about 0.4%. But we have Mara Holdings up more than 2.5%. Then we get the shares of Pfizer. They're up more than 3%, forecasting 2025 revenue in line with estimates. And finally, shares of Tesla still higher, up about 3% after closing at a record high yesterday. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
Thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. Paul, you okay now?
Better now.
He's better now. Okay.
They didn't have the goldfish, tried to go peanuts, and that was a little bit of a challenge.
You know what? That's happened before. I've had to actually stand in for somebody who had some peanut issue on air once. So I'm just saying, like, this is a thing that happens. All right, let's get back to the markets here. We do have some individual movers, which are kind of interesting. We want to start off with Pfizer, as both Lisa and Paul were just discussing. Alexandra Semenova is Bloomberg Equities reporter joining us. All right, give us the numbers for Pfizer.
Hey, guys. So great to be on with you. Basically, the company reported a forecast for sales and earnings that fell at the midpoint of analyst estimates. Analysts at BMO Capital Markets put it really well. They called this reasonable yet achievable. And we know that Pfizer has basically gone from being a pandemic-era darling with its vaccine rollout to becoming the target of activist investors. And Starboard Value has argued that Pfizer's board needs to hold management accountable for the company's underperformance. So basically, this report does a really good job at fending off some of those claims. It's kind of like a green light for Pfizer that things are okay. The stock is up right now about 4%.
Yeah, I read some of the research off the street, and it was just a lot of analysts looked at this quarter and saying, okay, that's just reset here. Yeah. Okay, we reset. The company's it seems like maybe the worst is behind in terms of those tough comps coming off the COVID vaccines, and maybe the company can now reset.
I mean, but TBD on what Trump's administration will rule when it comes to vaccines and et cetera. So there's also that question mark as well. All right, let's get to booking holdings. What's going on there?
Yeah, this is an interesting one. Not a big move on the stock, up down about 0.7% right now. But what they said was really interesting. They said that the impact of inflation is still dampening travel demand in the U.S. We, of course, just got 2 stickier inflation reports last week. They're saying that consumers are still price conscious and they're taking longer to plan their vacation. So basically not planning far ahead. But the interesting part of this report was they actually said that in Europe, people are still just booking their trips. They're booking their ski trips. They're booking as far as Easter vacations. So that kind of also speaks to the disconnect, I guess, between work culture in the U.S. and Europe.
Aruba, January.
Oh, okay. Did you book that already?
Yeah, that's done, dusted.
Okay.
Skiing with the boys, February.
Wow. Okay.
And then we just booked Italy for September.
Okay. Did I approve these days? Or
you approved them. Colin, it's another matter. We're still in negotiation with Colin. But it's all good. It's all good.
I'm just kidding.
So we're spending our money.
Okay, and then last up is Broadcom. So I appreciate the stock is down today, but just for context, it hit another record high yesterday.
Yeah, everyone's saying that Broadcom is having somewhat of an NVIDIA moment, basically having the same reaction to its earnings last week that NVIDIA had it in 2023 that kicked off the stock. The question now, though, is whether it can follow follow through on, some of its artificial intelligence promises, which we've been expecting from some companies. I'll give you quite a stat that one of my sources gave me. Since November 11th, when NVIDIA peaked, the entire move in the S&P rally can be attributed to just 3 stocks. That's Tesla, Apple, and Broadcom now. So not only the Mag 7, but we have Broadcom in the mix as well.
I mean,
is it Mag 8 or?
Yeah, I guess. I mean, it just doesn't feel healthy when you don't have the breadth.
No.
Yeah.
But since most people in their 401ks are long, just index funds.
So for now, they feel fine.
Yeah, exactly.
All right, Alex, thanks a lot. Alexandra Semenova, Bloomberg Equities reporter, joining us. All right, let's get to what many in the market are really hoping will happen next year, and that is the surge/return of M&A. You talk to any banker, and they are all singing the praises of more action within the M&A market. So let's see what actually might be realistic here. Michelle Davis is Bloomberg senior deals reporter joining us. Overall, you got global transaction values have risen about 16% this year to hit $3.1 trillion. So that's definitely something. What's the expectation for next year?
So the expectation is it's going to be better than this year. The question is how much better? Are we going to get back to 2021 where it was a record year, total euphoria, people were doing any deal they could think of? Probably not next year, but bankers are hopeful that maybe 2026 or 2027 we could get closer to that. And this year was better, but if you look at the numbers, it was still down compared to historical averages. We barely cracked 3 trillion. Last year, we didn't even crack it, but even 2022, after interest rates had already started increasing and, after Lena Khan was already in her seat, deal values were better than they were this year, so.
Michelle is another University of Virginia grad. They are
everywhere.
God,
You guys,
everywhere.
Seriously, you have a club.
Everywhere.
Wahoo-wah.
At Bloomberg?
Yeah, wahoo-wah.
No, they
All right, so
totally do.
You mentioned the regulatory overlook. I mean, presumably, Republicans controlling the Federal Trade Commission and the Department of Justice, presumably that would be good for deal making, because it seems like every big deal over the last several years that's been announced, boy, the regulators have taken a really tough look at it. Are bankers and lawyers telling you that that's going to be a driver?
Yeah, so that's the big reason people see things increasing next year, is because it's going to presumably be an easier antitrust environment. Now, the person who Trump has named to replace Lena Khan has also said that he's going to take a tough look at big tech, and tech is an area where we do historically see some of these mega deals. So, we'll see how bold companies want to be. And interest rates are another kind of wild card. Geopolitics, it's an expectation of folks that with the potential for tariffs around the world, companies globally are going to look to invest in the U.S. So that'll drive a lot of cross-border activity, but it also adds to some of those wild cards around investing.
Andrew Ferguson is who is nominated for the FTC chair, right? And then a new commissioner as well. But is there possible that we might actually wind up seeing just smaller bolt-on deals rather than these large transformative deals?
So the folks that we talked to say that they're expecting an increase across the board in all types of deals. So the bolt-ons, but also the bigger deals, maybe more of the MOE, mergers of equal type deals that seemed a little tougher in this environment. So yeah, they're optimistic, but deal makers always are, because
they have to be.
They have to be.
Exactly.
Yeah.
Exactly. But we had Paul Taubman speaking last week, and he formerly at Morgan Stanley, head of M&A there, now runs his own firm, one of the top M&A bankers on Wall Street. He says his firm, PJT Partners, they've been hiring bankers now for an anticipation and pick up of deals. To me, that was a really bullish sign. And is that kind of what you're hearing from some of the other M&A folks out there?
Definitely, yeah. It seems like the hiring is ramping up. Everyone I talk to says that their phones are ringing off the hook, that, CEOs are calling them with ideas or ready to explore things that maybe they were nervous to pursue over the last few years. And it's going to take some time to bring some of these to the point where they're ready to be announced, but definitely it feels like the M&A machine is back up and running.
Do we know how some of these deals might be more financed in terms of cash, debt, equity?
So because equity values have risen, it sounds like a lot of folks might be using their stock as currency, especially on the acquirer side, and that'll also make sellers more open to selling because they don't feel like they're selling at a huge discount. cash, I mean, we'll always see that from the companies who have strong balance sheets. But, you know, on the private equity side, that increasing in financing costs has been one of the things that has made it tougher for them to do the types of deals that they were doing previously, just because you know, to get the same level of returns on their deals, it just costs them more money.
I mean, I've always learned, I was taught that if you're going to do M&A as a board member, as a senior executive, you really have to have confidence in the economy, your business, lots of things like 5 years down the road. You have to think that far in advance. So before you commit to an M&A deal. So maybe that's kind of what we're seeing here. So anyway, Michelle, thank you so much for joining us. Michelle Davis, Senior Deals Reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. I think, you know, just the change in the regulatory framework, I think it's going to free up a lot of people, because a lot of the deals, you think about some of the airline deals that got blocked here. I mean, these are, I don't know, it just seems like it was an environment over the last several years where if I were returning, I'd almost be like, just wait and see what happens in 24.
But the thing is, the regulatory environment can then change again.
Yeah,
like
true.
Even so, like you're saying, oh, Google, we're going to wind up maybe making you break this off or do this or do that. That's something they already did years and years ago. I don't know how you deal with that if you're a CEO, or you're not worried about it and you're like, look, I'm just going to go with what's in front of me.
Right. And I think we'll see some of that from some of these companies. So.
All right, well, we are going to break down more of these markets for you, seeing a little bit of a sell-off today. James Abate is Managing Director and Chief Investment Officer over at Center Asset Management to discuss. Also, Sam Pizzelli, Bloomberg Intelligence Director of Research. That guy. We're going to talk about Pfizer and also what wine he's going to drink on New Year's Eve. Yes. That's what I want to know.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks falling, traders taking in more economic data. This includes strong U.S. retail sales. Also, a report on industrial production that fell for a third month in November. It comes all ahead of the Fed's decision on interest rates and its forecast tomorrow. The Nasdaq up 0.7%, 155 points at 20,017. The Dow up 0.5%, 222 points, 43,494. The S&P 500 down 0.5%, again 34 points at 6,039. We have the two-year yield 4.23%. That's down 2 basis points, and we have the yield on the 10-year 4.38%, and that's down 1 basis point. And speaking of which, T. Rowe says Treasury 10-year yields may reach 5% in the first quarter of 2025 before potentially climbing to 6% for the first time in more than 2 decades. We head over to commodities. We have Brent crude $72 a barrel, WTI crude down more than 1.5%, $69 a barrel. Spot gold lower, $2,640 an ounce. The Bloomberg Dollar Spot Index is little change, and we have Bitcoin above 106,000. Few stocks on the move. It's Broadcom. After closing at a record high yesterday, shares this morning, they're lower. They're down more than 5.5%. Shares of NVIDIA also continue to fall, down more than 3.5%. And finally, shares of AI server company Super Microcomputer, well, they're on the rise. They're up about 3%, and that's after falling yesterday following news it'll be removed from the NASDAQ 100. For on-demand news 24 hours a day, subscribe to Bloomberg News now. Wherever you get your podcasts, I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. One thing that we are watching here, it's a red headline that crossed the Bloomberg terminal, is that Brazil calls a spot U.S. dollar auction. So that's when you initiate an action to buy or sell U.S. dollars at the current market price. It's a form of currency intervention. You take a look at the dollar real, for example, it's right around record high. It's like 6.17. So this is just clearly a strong dollar putting the Brazilian real under stress, and then the country trying to take steps to manage that. So we'll bring you any more headlines. The real trims its losses after the central bank called that USD auction. All right, let's get back to the markets here. Bank of America had an interesting note out that said, look, guys, cash levels are going to the point where you might actually want to start selling equities rather than buying them. Apparently, fund managers have been reducing cash holdings to a record low, and they're now below 4%. So is that a cue for you? Well, joining us now for more is James Abate, Managing Director and Chief Investment Officer over at Center Asset Management. James, is there a sell signal within the equity market?
Well, I think if you look at, just like at the tail end of the dot-com bubble, clearly price momentum and valuations now are beginning to outpace the improvement in fundamentals. I mean, just looking at the top 10 stocks, probably the biggest disconnect is in Microsoft and Broadcom. I mean, clearly what we see that's similar to the dot-com environment, namely like a company like Cisco in 1999, you have returns on assets or returns on invested capital trending lower, highlighting that margins and our asset efficiency is rolling over despite sales growth. Heavy CapEx in the case of Microsoft, acquisitions in the case of Broadcom. The other Mag 7 are simply overvalued, but there's no evidence yet of fundamental deterioration to the same degree that we see in those two names. But there's no margin of safety for investors. I mean, the group as a whole is trading at 13 times sales.
Yeah, exactly. The valuation is just extraordinary. The only differential I call out from the late 90s is they actually have earnings and free cash flow, which is a little different from some of the stuff I was selling back in the day. James, where do we go here in 2025 if, in fact, we have some valuation concerns in this market?
Well, I think, the way we look at stocks from a valuation perspective, we emphasize future growth reliance. That is essentially, what is the metric companies need to reach to be able to justify their existing valuations. And for us, on the overall S&P 500, the measure now hasn't been this optimistic on future economic profit creation going forward since 2009 and close to the all-time high back in 2002. Now, those times we were both at the bottom of a very deep recession and set for a very sharp cyclical recovery. And the S&P 500 PE multiple back then was at 11 and 13 times respectively, not 24 times like they are now. So we have to basically essentially see a rapid acceleration in economic activity just simply to justify, the multiples that we're seeing today. And we have a hard time reconciling those figures with what we're seeing from a bottoms-up perspective.
So what's your best well, not guess, because you're actually putting money to work, but what's your best setup then into next year?
Well, I think when you look at next year, you have to think about two events happening, right? We have, heading into the year, investors appear to be universally bullish. In fact, we saw yesterday the Conference Board's consumer confidence survey showing individual investors being the most bullish they've been in 40 years. And consensus seems to be that nominal economic growth is going to be exceptionally strong. Profits going to accelerate, and additional fiscal and monetary stimulus might help further, and a broadening out of market performance. I mean, at the same time, this is happening while manufacturing PMIs remain stuck in recessionary levels. Services actually appear to be rolling over. And even today, U.S. industrial production and capacity utilization fell, not showing any type of inflection. So our view is to stay defensive. We think long treasuries might be the ultimate contrarian trade for 2025, and classic defensive growth stocks in healthcare and staples, although very out of favor right now. But many of you could pick up that PEs of 9 and 10 is the place to be heading into next year.
How about fixed income here? Do I sit my 2-year treasury at 4.24%, or do I take some credit risk?
I would stay away from credit risk. Clearly, if you think that the economy is not one where the cyclical or industrial side is going to catch up to at least the buoyancy in the services, I think you want to, with credit spreads being at extremely tight levels, consistent with really a zero equity risk premium, you want to be in safe assets, and that would be treasuries instead of credit.
All right, James, thanks so much for joining us. Always appreciate getting a couple minutes of your time. James Abate, he is Managing Director and Chief Investment Officer at Center Asset Management. He is in New York City. Earnings story out there. Pfizer, our good friends at Pfizer, put out some numbers, and I guess some of the research I read on the street was, okay, it's steady as she goes, and I think that probably more than anything else is lifting the stock here. What you didn't want to see is perhaps another disappointment, and maybe that's kind of what the street got. Stock is up 4.6% today. Pfizer is. And remember, this is a $150 billion market cap company. It's up 4.6% today, but down 8% year to date. So again, kind of continuing, it seems, to deal with some of the hangover post-pandemic. And nobody likes the badmouth pharma companies and high drug prices more than me around the Thanksgiving table.
True story. Mm-hmm.
But I've changed my tune since the pandemic and how they rallied and got us a vaccine in 12 months' time. So they get a big time pass from me. Sam Fazeli joins us, Bloomberg Intelligence Director of Research for Global Industries, and he also covers the pharma industry as a side hustle. Sam, talk to us about Pfizer. Talk to us about the results and kind of maybe some of the guidance they have for investors.
Yeah, Paul, thank you, and I'm glad you've joined the group that actually likes pharmaceuticals. These are the companies that have created vaccines, which is why most of us are alive.
Exactly.
Antibiotics, right? Most of us are supposed to be dead by 40, 45, right? In the old days when you ran around with a club. So look, this is the story, as you absolutely rightly said, about a company that didn't disappoint. I think having seen what happened during 2024, this is the company that people were a bit worried about. Is it going to come out and give us a whole bunch of guidance that is actually below consensus? And here we are with something that's in line with consensus pretty much mostly. There are some moving parts that's you need to think about if you want to get into the nitty-gritty. But at the end of the day, it's pretty much in line with consensus, and that's a sigh of relief for a stock that's pretty much close to, I don't know if it's an all-time low, because this company's been around for a long time, but it certainly is a very weak share price compared to where it's been before, especially in the height of the pandemic with COVID sales and everybody thinking it's going to be a $100 billion market a year. So that's where we are.
Speaking of vaccines for a second, we were watching the Patrick Stewart Scrooge movie. We like to do Christmas movies, and my daughter goes, when was this set? Like in the 80s?
Right.
So to the point where like, no, honey, like it was a long time ago, and we would all be dead at this point if we lived in that time. Okay. Yeah. But I guess my question is, how do we have conviction on what these stocks are going to do next year when we have no idea what the administration is going to be like or what their relationship with drug companies is going to be like?
Yeah, but Alex, the government can't change things overnight. right? So by the time they take office, by the time they start putting new laws into play, which of course one of them is now possibly going to be some way of trying to rein in the PBMs, the pharmacy benefit managers, the middlemen who take the big fat chunk of profit out of these high drug prices. By the time that happens, it'll be 2026 or something like that. The reality is that it's all going to be about rhetoric, right? So are we going to have a Health and Human Services run by RFK anti-vaccine? Is he going to tone down his anti-vaccine? Is he going to get confirmed? So it's going to be all about the optics of it, and it's also all about the rhetoric. No real impact, but investors don't look at what's happening next year. They always look at 2 or 3 years down the road. Now, here we have a company that's dealing with IRA. I think it's the first pharma company that's put out their guidance, and they're saying that the changes in the IRA, which are good for patients, by the way, I have to say that right up front, is going to hit them about $1 to $1.5 billion, I think the number, $1 billion. So 1.5% hit, right? So that's because they're going to be having to cover the catastrophic pay that in terms of the Part D Medicare coverage. And of course, they've got drugs that are high priced. So that sort of thing I do expect. And of course, you know, sentiment is all in our world. So maybe, but, you know, stocks like this, which are already hammered, you know, they come out with an inline guidance and the share price goes up. So it just tells you where we are in some of these names.
One of the great new functions on the Bloomberg terminal is MODL for financial models. And this is where Bloomberg Intelligence and Bloomberg have compiled a lot of the earnings estimate models from a lot of the leading Wall Street analysts. And what you see there is for a company like Pfizer, they got a lot of drugs, and investors really focus on the various drugs and how they're growing. What do you focus on for Pfizer, Sam?
Yeah, so Pfizer's 2025 is about execution and getting this new company that they bought, Seagen. It's not that new anymore. It's a while ago that they bought it, fully integrated and managing those costs. If you think about it, a lot of what they've said today with regards to the growth on the EPS line is due to managing costs. So they've come below some Wall Street expectations in terms of sales and marketing costs, and you know, within, you know, even R&D costs. So but that's been the case. This is a company that's trying to find its new world in the new world of COVID. How much vaccine am I going to sell? How much Paxlovid am I going to sell? Remember, that's a $9 billion line or so, right? That's not a, you know, for a company that's guiding to 61 to 60, whatever the number is here, $61 to $64 billion sales range. So that's where there was a lot of sensitivity and worry. And of course, they've said, I think we're on a straight line from last year to 2024 to 2025. So that's where the worry was. And frankly, new drugs and stuff, it's always important, but we need to see the data to come through.
All right, Sam, thank you so much for joining us. Sam Fazeli, he's the Director of Research for Global Industries, and he's a Senior Pharmaceutical Analyst for Bloomberg Intelligence. He's based in London, sometimes France, sometimes other places. The guy's all over the place, but we appreciate getting a few minutes of his time. Again, Pfizer putting out some numbers today, and the street likes them. Stock's up 4.6%. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks falling, and this is a day after another record closing high for the NASDAQ 100. We'll start with the NASDAQ right now, down 0.6%, 121 points at 20,052. The Dow down 0.5%, 250 points at 43,468. And the S&P 500 also down 0.5%, but 30 points at 6,043. We have the 2-year yield at 4.24%. That's down 1 basis point. The yield on the 10-year 4.38%, and that's down 1 basis point. Over to commodities, Brent crude down more than 1.5% at $72 a barrel. WTI crude $69 a barrel. And we have spot gold lower about 0.5% at $2,639 an ounce. The Bloomberg Dollar Spot Index is little changed. We have the Japanese yen up about 0.4% at 153.47 against the dollar. Euro weaker, British pound stronger. We have Bitcoin above 106,000. Who's making news? That's Alibaba. It's going to record a $1.3 billion loss on the sale of its in-time department store business. And then you have buy now, pay later company Affirm. It plans to sell $750 million in convertible notes and use those proceeds to buy back some of its stock and other securities. Now, as far as earnings this week, tomorrow it's General Mills before the bell with Lennar and Micron Technology after the close. Then we're on to FedEx and Nike on Thursday. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. So something is evolving quite interestingly in the oil and gas market for next year. Yeah, we still care about shale, and we care about Guyana, and we care about the Saudis. But offshore drilling, particularly in the Gulf of Mexico, is becoming more and more of a topic in conversations among my oil and gas folks. And let's get to one of them now. Brian Gavari is chairman of Ineos Energy. Ineos Energy is a private company, and it recently bought CNOOC, which is a Chinese oil company, Gulf of Mexico assets. Brian was also the former CFO of BP, so he knows like a thing or two about how to put together assets and finance them and do stuff with them. Brian, it's good to see you. It's been a long time.
Hey, good to see you as well, Alex. It has been a while.
So tell me what led to this acquisition, why'd you like it, and why now?
Look, we created Ineos Energy just literally out of COVID in 2021. We brought together a collection of oil and gas assets we had. We did some major portfolio transition. We took a big U.S. onshore position last year from Chesapeake, so that sort of built up a decent-sized 2,600 well position there, an LNG export option, and then the next obvious spot to go to was the offshore Gulf of Mexico, which is probably one of the highest margin barrels available globally. And we've been looking around now for the best part of 3 years for the right deal, and this was the right group. It's a great team that we get with this. It's the ex-Nexen team that CNOOC had acquired. So we'll get Heather, the CEO, and Ariel, the CFO, as part of that transaction will come across. So, yeah, we're pretty happy about it.
So talk to us about that part of the world, energy in that part of the world, the Gulf of Mexico specifically. What are the dynamics of getting a barrel of oil out of the Gulf of Mexico? Seems like a tough business.
No, look, it's one of the most prolific basins in the world. I've got personal experience of it from sort of, 20, 30 years ago, of the early pioneering groups of effectively back then Chevron, Shell, BP that kind of went into that zone. I think there's still a lot of legs. And I think the most important thing about that particular region is we've got a very stable fiscal regime. Its successive governments have continued to support that region in particular and the onshore. If I think back to the last conversation, Alex, I think it was when the Biden administration was coming in and there was concern about what would happen with onshore fracking in the United States. That's got to record highs. I mean, the U.S. now accounts for something like 20% of all of the world's oil production, including condensate and natural gas liquids. So, look, it just continues to be a great place to do.
Exactly, which is so interesting. So you have now Gulf of Mexico, so that's deep water. You have LNG export assets, and then you also have gas. How are all of them going to wind up working together?
Well, look, so we'll be exporting LNG probably 2026 onwards. We have the new contract in place. We have effectively over the last 18 months repositioned that onshore position that we picked up from Chesapeake, the Eagleford position, which was mostly oil. Actually, it's like sort of 85% oil with oil liquids. It's got a decent amount of gas in there. These two assets, they're non-operated. We've got great operators in both. Shell in one asset, Hess in the other, which is obviously becomes Chevron. And we'll learn a lot about that particular region. We then also have a growth oil business in Denmark and a gas business in the UK. So we'll start to bring that virtual web together. And as you'd expect, Alex, on top of that, what we're building around that web of assets is a trading business, both LNG, gas and oil trading. So that will then start to ensure that we can pick up the incremental value that comes from moving those products around the world.
What's the competitive environment for you in kind of your businesses there down in the Gulf, down in the South Texas area? How do you compete against some of the bigger companies there? What's the strategy?
I mean, in this case, we're not operated, right? So we get carried by the two main operators, which, as I say, are sort of there's two sort of top operators in the Gulf of Mexico, and have got the long history of operating there. So we'll get carried as part of that. We'd like to get to an operator position. I think we have big ambitions. And when we started to create this company out of INEOS already massive footprint in the United States as a petrochemical company. Yep. And as we started to build up the energy business in 2021, you know, the ambition of our owners, Jim Ratcliffe and his two partners, has no bounds. And therefore, I could see us at some point in the future building this out into something much bigger, maybe in the same sort of size as our chemical company.
Hey, Brian, before we let you go, talk about the trading part of it. Because clearly BP's trading arm is the giant, right, of all the oil majors. Exxon has wanted to kind of build up its own trading unit. Like, everyone kind of wants a piece of that pie. How are you guys going to do it?
Look, it's really hard. You have to have the DNA in your system to really be successful. We've hired a couple of people that we know well. The first thing we did over the last 6 months, actually last 18 months, we built out a risk structure. Because, of course, if you're going to trade commodities, you need to absolutely ensure that you have the right risk framework around that. So we built out the risk capability. We've started now getting ramped up for our LNG trading operation, which should start in the next 2 years. And then oil trading is short steps, but it's with an experienced team that we already know. And, of course, because we have this massive industrial footprint called INEOS, it's the third largest chemical company in the world, that gives us access to flows globally. So that'll be short steps, but the key is to make sure that we've got that capability that allows us to add those extra cents to the margin on a barrel.
All right, Brian, really looking forward to getting a more update from you. Keep in touch. Let us know when the next events happen. Good to see you, Brian Gavari. He is joining us from INEOS. He's the chairman of INEOS Energy, previously the CFO of BP, which is where he and I started talking years and years and years ago. So you see kind of the evolution of someone's career is really quite interesting.
I want to get on one of those offshore rigs.
Me too.
Let's see if we
Did you know that if you do that, though, you need helicopter training?
Helicopter training?
Yeah, so
just to be a passenger?
Yeah, so the helicopter training is you're in a pool and they put you in a helicopter and they dunk you and you have to swim out by yourself, and you don't get certified unless you're able to swim out by yourself.
Oh.
And one of my biggest fears is doing that. So
that's an issue. Okay. I'd still like to try it, but even, all right, we'll see how it goes. Because I always thought that would be, I can't imagine being out in the middle of the ocean on one of those things.
Yeah. Well, especially,
and then doing that dangerous, hard work, too.
Yeah. Well, that's why the automation piece of oil and gas is so critical, because if you can do that, reducing the amount of people that you're putting in any sort of harm's way offshore, like, that's huge. Yep. And that's an industry, and mining also, where like that automation hand is not just a cost saver, it's like a lifesaver. Yep. So it's interesting to see how they manage on with that. Taking a look though at the commodity market, oil not doing so well today. It's off by about 2%. When you look at WTI, we're now trading at $69 a barrel. No one I've seen is particularly constructive for oil for next year. Everyone sees the geopolitical risk and everyone sees the demand risk at the same time.
Yeah, it's China on the demand side, as I understand it, talking to the experts. And then the supply is there. I mean, OPEC is doing what they can, OPEC Plus. But, I mean, the U.S. is still cranking it out. So it seems like there's ready supply and the demand is uncertain at best, I guess, at this point.
Yeah, I mean, if you think about it, the U.S. is the largest oil producer in the entire world.
Yep.
Like, take that in for a second.
Yeah.
I mean, that's kind of insane.
And that's just in recent years.
Yeah.
It's just amazing.
A huge shift in the dynamic. Anyway, super fun stuff. Coming up, we're going to talk to Victoria Denrenew, a Bloomberg U.S. Treasury reporter, on the great Bloomberg Big Take on U.S. debt. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stage ahead of you. And I think this is generalizable to not just the startup, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
That strategy was to, essentially weather the higher interests at the time. So if we're going by what Scott Bessent has said or other people in the kind of Trump economic orbit, we could see a shift in focus to longer treasuries. But it's always different, experts tell us, when secretaries actually become secretaries and they deal with kind of a more holistic view of how issuance works and the feedback they get from markets as well, which is very critical to this.
I mean, the deficit, the national debt, obviously very complex issues, but the remedy at its most basic level is very simple. You either cut your spending or you raise your revenue or you do some combination of the two. And again, I haven't heard anybody talking about tax increases, and I haven't really talked to anybody about major spending cuts. Are we waiting for some policy to come from somewhere?
No, I mean, that's the problem is that, well, the problem, I guess the issue in looking at the outlook is that a lot of the big ticket spending items come from areas of spending that's so-called mandatory spending, so entitlements, Medicare, Medicaid, Social Security, that any party is very unwilling to touch, very politically difficult, or defense spending, for example, which is also kind of notoriously difficult to cut. So there's no low-hanging fruit per se. I mean, the Trump administration will have DOGE, which is meant to, cut spending through efficiencies, but none of the experts we spoke to think that that could yield nearly enough to change the trajectory.
Right, and therein lies the issue. All right, thank you so much. It was a really great piece, guys. I'm encourage everyone to check that out. Thank you so much for helping us break it down. Victoria Denrino, Bloomberg U.S. Treasury reporter on the Bloomberg Big Take. We have another great hour coming up on Bloomberg Intelligence. We're going to break down U.S. retail sales. They were actually slightly better than estimated. Apparently, we're buying cars now again.
Nice.
Right? Still shop on discount, though, so my people still reign. Mari Shore, senior equity analyst over at Columbia Threadneedle Investments, will be joining us. You're looking at a market here continues to trade a little soft on this Tuesday. This is Bloomberg.